where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
.45 Eastern Time, equity futures on the S&P 500 firm up here by 0.1%. Under surveillance this morning, bank earnings wrapping up on Wall Street.
The net interest income comparisons for all the banks on a year-over-year basis has been negative, with the exception of JP Morgan. I think that's going to be one of the biggest trends that most investors will focus on. They're looking for the inflection point when net interest income growth on a year-over-year basis turns positive. We expect it to happen in the second and third quarter of this year.
Just getting numbers from Bank of America to wrap up some of those earnings on Wall Street. B of A just dropping, Morgan Stanley a little bit later with the numbers. Here's Shonali Basak. Hey, Shonali.
Good morning, John. Not only do you have Bank of America beating on net interest income as well as on trading led by equities trading, very importantly, you have Bank of America giving guidance for what they expect to bring in net interest income later this year. They expect that number to jump from the $13.9 billion you're seeing in the second quarter to about $14.5 billion. So an increase through the end of the year in net interest income. That guidance is critical. What do they expect this to come from, John? That's the most interesting part. You remember maybe those held to maturity securities that have been dragging on Bank of America stock the last couple of years. They believe that they could reinvest these securities, and what we understand is about $10 billion roll off per quarter, so about $40 billion a year, now into higher yielding treasuries. This is also a reinvestment of assets like mortgage loans and auto loans that had been extended at lower interest rates, now moving into higher interest rate products. So higher for longer, helping Bank of America out. A little bit of a lift in the stock pre-market, as you can see. Of course, a strong read here across the board. Real quick note here on credit quality. You have provisions for loan losses meeting expectations, charge-offs about meeting, coming in just a little higher than expected. Charge-offs of $1.5 billion, relatively flat from the first quarter and up from $869 million in the second quarter of last year.
Shonali, just want to talk about trading revenue. Decent beat here. I want to sit on that a while longer. 4.68 billion, the estimate 4.53. 0 days of trading losses in the second quarter of 24. I'm looking ahead to Morgan Stanley now at 7:30 Eastern Time. How high is the bar for Morgan Stanley now?
Very high, John. And the reason being, we talked about it a bit yesterday. You might remember Goldman ended yesterday at an all-time high. And when you saw their equities trading number, it came in above JP Morgan's and above where Morgan Stanley is expected. This has been a traditional, very historical rivalry. All of these banks are leaning hard into their hedge fund clients, really leaning on that prime brokerage at a time where markets are still volatile, and clearly these trading desks are benefiting from them.
Hey, Shonali, tremendous work. As always, we'll touch base with you when Morgan Stanley drops. Bank of America just behind us, up in the pre-market, up big time so far this year. Year to date, B of A up 24%. Goldman's up about 28. Morgan Stanley has really lagged. Year to date, it's up by about 13. Still a decent year, but it's lagged the pack. We'll hear from Morgan Stanley in the next hour or so. Joining us now to talk about bank earnings is Chris Marinac of Janney Montgomery Scott. Chris, wonderful to catch up with you, sir. We've got a lot to talk about. It's particularly the rally in small caps and the regionals, but I want to start with the earnings from the big players on Wall Street first. We've had JP Morgan, we've had Citi, we've had Bank of America. What stands out for you, not just this morning, but over the last week?
Well, net interest margins aren't really increasing yet, John. I mean, I think we have this final quarter where margins bottom. We're happy that the cost of funds at B of A was only up marginally, so they're still the leader in terms of low cost deposits. I think that yields are going to get better as things roll over on the upside, but the cost of funds has to come down. That's where the Fed policy, the possible shift in interest rates, third and fourth quarter could be very useful. I was very thankful that the criticized loans were flat in the quarter from Q1. Charge-offs only up 1 basis point. The provision was higher. They did build slightly, but I think overall that was a win as well. But you're not really seeing the big revenue growth on the spread side. Investment banking, as you mentioned, was definitely higher, so no issues there. That was a beat. I think expenses acted well, but no major surprise on the expense front.
Chris, I went through the year-to-date gains for the stocks of some of these major players. If you go over the last 12 months, you can double it. They've been tremendous. Chris, there was something about this environment in the last year that has been particularly good for the bigger players in the financial world. Is something changing, Chris, where you think things get better for the smaller, the mid-sized banks, the more regional players?
Sure. I think on the regional and the smaller players, I think what you have is the cost of funds is beginning to crust. That was the major challenge even before you had the Silicon Valley and First Republic failures last year. I also think that, generally speaking, the expense leverage in this business is very good. We've seen banks much more efficient today than they were 15 years ago, John, and that's a tremendous difference. The cost of technology is helping banks do more with less. I think they're getting much more efficient with their staffing. They still have to spend money, but I think they're much more efficient at doing so. So I think as we get to a period where the cost of funds comes down or at least flattens out, that's going to lead to better spread income. And I think overall the expense leverage is still there for the industry.
The move in regional banks over the last few days has been absolutely phenomenal. Chris, I think we're up by something like 11% in just 5 days. There was a note from Citi just yesterday from Scott Kroner. I'm going to share it with our audience. Maybe you've seen it. Overweight US banks, our preferred Trump trade, easier valuation setup, stable fundamentals, lesser tariff risk, combined with incremental deregulatory inertia, give this sector a good risk-reward setup. It's the conversation at the moment, Chris. How would Trump's second term influence, shape the performance of these stocks?
Well, John, for sure the regulatory environment's going to shift. I think regulation can very much have peaked in terms of the angst in the industry. Under a new administration, you would see regulations change dramatically. I think it would take about 18 months to really affect. The rank and file do not change that quickly just because the head of the White House changes. But it is going to be a perception shift, which is going to be anticipated and already is by the stocks. The banks were trading at 48% relative multiples last week. Today, they're 53 or 54 relative PE to the S&P. That has a long way to go because we used to be at 66 to 70%, median range for the last 10 years. So there's a lot more valuation to recapture. The regulatory perception change is a massive one. We have to see the follow through in the fall, but that certainly is a very good start the last several days.
We heard J.D. Vance, the former president's VP pick, in the past talk about big banks, but also talk about regional smaller banks. He says community lenders, he thinks they operate at a financial disadvantage to the biggest banks. Would that be another reason why to potentially put on trades for some of these smaller regional players?
Well, sure. I mean, I think you have to have a regulatory framework that's going to fit the community banks and it makes it easier and less onerous on them. I think having the trickle down to the same regulation applied to a $100 or $200 billion bank on one that's $1 billion or $2 billion is just very difficult to execute. It gets back to the opposite of the expense leverage I was mentioning. So if we can have relief there, that is a tremendous shift. I think that is a possibility. I do think it takes time, but that absolutely happens. The small banks are the major lenders in the country. Small businesses are still they generate the new jobs, the new activity in the country. That's where community banks really do their best work.
Hey, Chris, wonderful to hear from you, sir. Appreciate the setup there for the big banks this morning and the regional players as well. Chris Marinac there of Janney Montgomery Scott. This is one of the conversations at the moment, the outperformance we're seeing in small caps and the regional players. I mentioned KRE, the regional bank index. 5 days, we're talking about double-digit gains across 5 trading sessions.
I'm obviously looking into political rhetoric for some of this. After the collapse of SVB, what did we hear from Senator J.D. Vance? He sits on the Senate Banking Committee. He says the executives responsible for running their banks into the ground are sitting on millions of dollars in compensation and bonuses. Meanwhile, the American people are bearing the financial burden for their excessive risk-taking and gross mismanagement. But he likes to talk about and prop up this idea of community lenders, regional banks close to people at home that he's serving in Ohio. And this is the message he's going to take to the Rust Belt.
How different would it be if it wasn't the likes of President Trump and J.D. Vance and we got President Biden, Kamala Harris, Volume 2. How different would it be for the banking sector?
Well, the idea here is, at least in the legislation I was looking at overnight, trying to remember where exactly J.D. Vance lined up with Elizabeth Warren, that's where it is. And there's a lot of Elizabeth Warren acolytes in this Biden administration, and some of them line up when it comes to things like big tech, antitrust, big banks. They line up squarely next to J.D. Vance.
Pause, because I think we have to talk about this. The party of Reagan is a long time ago. Even the party of Paul Ryan is a long time ago. The makeup of Congress right now, what is the Republican Party and how pro-business is it in the sort of conventional, stereotypical sense?
It's divided, I think is the fair way of putting it. And I think this was on display last night when you had the Teamsters head come out and rally against big business at the same venue where you're obviously going to also have maybe a representative from the Chamber of Commerce. These are the two different paths for the Republican Party. J.D. Vance squarely sits in one, as opposed to maybe someone else the former president could have chosen, like a Nikki Haley or a Glenn Youngkin. He is sitting firmly, his ticket, in the base of the Republican Party right now, which is not always friendly to big business.
We've got a lot to talk about in the second hour of Bloomberg Surveillance. Here's the lineup for you. Coming up next, Henrietta Trays of Vader Partners, Dan Greenhouse of Solace, Robert Koenigsberger of Gramercy Funds. Look out for that conversation. Robert on EM and what a second round of Donald Trump could mean for emerging markets worldwide. We'll also speak to David Malpass, the former World Bank president. A lot still to come from New York. This is Bloomberg.
To the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about. They fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
policy changes that could come in the first 6 months alone of next year are probably the greatest that I have ever seen in my lifetime.
If we get increased geopolitical risk, it's going to come with a slowing economy.
Markets can't resist the idea that there's going to be some sort of seismic swing, and yet over the past few cycles, it really hasn't happened.
The reality lies in the results. And I think we're going to see the results over the coming weeks.
It's an interesting inflection point, and we will see who can take advantage of that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance begins right now with equity futures positive by 1/10% on the S&P. This is what the day ahead looks like for you. We've had numbers from Bank of America. Later this hour, we'll hear from Morgan Stanley. Later this morning, 8:30 Eastern Time. Do not miss retail sales. Then at the RNC. I said this earlier this morning. This would not have been on the schedule until Saturday evening, when a phone call was made between the former president, Donald Trump, and Nikki Haley.
And also the fact that Donald Trump is talking about not just uniting his party with you showing support, reaching out to Nikki Haley, asking her to come in and give this address to try to do that, but also he himself says that he's throwing out his old script. This speech he's going to be delivering Thursday evening, and he wants to talk about unifying, which is why Terry Haynes says he picked J.D. Vance. This is an individual that can be the attack dog in the camp, and Trump can act as the unifier in chief.
I can tell you for investors unifying around one thing right now, small caps. Check out the futures board again this morning. We've seen this repeatedly over the last week. The S&P's up by 1/10. The Russell's up by more than 1 full percentage point. We're lucky that Danny Berger's back in the studio with us. Danny, this thing continues.
It's got everything going for it at this moment, up more than 1% for the past 4 days. You think about the bond market and how much it can really get more juice from trading the Fed. It can't really. It already has 2 cuts priced in. What's been so unloved with rate cut expectations is small caps. So put that in the positive camp. And then you get the debate, and then you get a deregulation potentially from Donald Trump, what that means for regional banks. And then you add in to that J.D. Vance and his dislike for big tech. I mean, there's so many things going for the sector right now.
Can we get to the Senator Vance point first? He has not missed the big business. Are we saying this administration, if we get a second term, are we saying it's all about the small caps?
Well, at least the vice president is. And I guess the question still remains, how much can he influence Donald Trump? But look, I think there's been some confusion to say, I don't understand. Why is Silicon Valley behind this guy? Why would big tech like him? I mean, we need to remember that Silicon Valley right now is small tech. And that is his background. He's a guy who saw SVB happen, and everyone came and lobbied to him and Elizabeth Warren. His background very much so is not for the big tech of the world. And that's a potential risk to what has been the high-flying sector of this bull market rally.
Key point there, Danny, which is whether or not he can influence the former president. It's the opposite way around. He will be signing up to former President Donald J. Trump's agenda, and he is going to see that through. So if Trump gets a phone call that needs to maybe back off some of these big business issues, I think J.D. Vance is an individual that's going to get in line. And he was chosen, I believe, partially for his loyalty to the former president that he has shown.
Is it the economics? Is it the Federal Reserve? Is it the politics? At the moment, it's all working for the small caps. The Russell outperforming. Equity futures on the S&P positive here by 1/10%. The scores look like this in the bond market. Yields lower by 5 basis points, 417.89. There's a big data point a little bit later that might shake up this market. Retail sales just around the corner at 8:30. Coming up on this program, we'll catch up with Henrietta Trays of Vader Partners as Donald Trump picks J.D. Vance as his VP, Dan Greenhouse of Solus with stocks near all-time highs, and Robert Koenigsberger of Gramercy Funds on what a second Trump administration could mean for emerging markets. We begin with our top story, Donald Trump announcing J.D. Vance as his running mate. The two appearing side by side at the Republican National Convention, the former president sporting a white bandage over his ear in his public appearance, the first one since the attempted assassination. Bloomberg's Kelly Lyons joins us now from Milwaukee, Wisconsin for more. Kaylee, Nikki Haley, we need to start there. Nikki Haley would not have been appearing if it wasn't for the events, the tragic events of Saturday evening. What is the content of this address going to look like, going to sound like a little bit later?
Well, we have heard Nikki Haley's tone around Donald Trump itself change since she dropped out of the Republican primary all those months ago. Of course, she was not initially invited to this convention, and the fact that Donald Trump did make that extension over the weekend in the aftermath of the attempt on his life does show that maybe there is some serious behind this messaging around unity that he says he's going to start espousing more and recrafting his speech on Thursday to address. So when Nikki Haley speaks later on this afternoon, she is likely to say some similar things about the idea that the Republican party, especially those voters who cast their vote for her, would now need to unify around this ticket, which of course is now Trump-Vance 2024. She had previously said when exiting the race that those voters who cast a vote for her during the primary process, Donald Trump needed to earn those votes. So what I'm really curious to see is if Nikki Haley suggests that he has now done so, if she does outright endorse him, which of course she has. She said she's voted for him, but also say that everybody needs to circle the wagons and cast a vote for him. It's all part of this tonal shift that we are now seeing at this convention in Milwaukee, and we'll see in the days to come. Everything seems to have changed very much since Saturday, although perhaps not the selection that Donald Trump made in his vice presidential pick, as he still went with an attack dog in J.D. Vance.
And the attack dog that he's going to put squarely in the Rust Belt. This individual is going to be campaigning in these 3 critical swing states, which, Kaylee, new polling out today shows the president is down in all of them. What's the message that you think J.D. Vance is going to bring to Pennsylvania, Wisconsin, and Michigan?
Well, those key states in particular, the Rust Belt states, is where he has the most obvious appeal, given that he is from Ohio. He outlined in his memoir, Hillbilly Elegy, his upbringing in a town that was plagued by a number of issues and poverty due to the manufacturing decline in that area. So in some sense, those are the kind of voters he can reach. We know he has been very outspoken, for example, in regard to the steel industry, which has ties not only to Ohio, but Pennsylvania as well. Even a separate swing state, Georgia, when I spoke with the governor, Brian Kemp, yesterday, he said the messaging power of J.D. Vance does have the appeal to apply to all swing state voters. The idea that he has an ability to articulate well the economic policy of Donald Trump and why it may work better for people who are hurting in their pocketbooks than what they've seen under 4 years of the Biden administration. I would also note, while we talk about the appeal J.D. Vance may have with working class people, with these kind of ideas of populism, he also does have a lot of influence with powerful people with money, knowing that before his political career began not all that long ago, considering he's only held his Senate seat since January of last year, he was a venture capitalist. He is a Peter Thiel acolyte. Peter Thiel is one of his biggest backers who could now contribute financially to this campaign. And of course, there's other billionaires who have come out in support of this ticket as well. Elon Musk expressed his happiness with the selection of J.D. Vance yesterday, and new reporting from the Wall Street Journal today suggests that Elon Musk is preparing to contribute $45 million per month to a new PAC supporting Donald Trump, the America PAC, that is going to focus on turnout. And we know turnout is going to be key ultimately in deciding the outcome of this election.
Big money. Kenny Nice, thank you, from the RNC in Milwaukee, Wisconsin. Let's take some time to try and answer some of the questions I know you've all got. Joining us now is Henrietta Trays of Theta Partners. Henrietta, one of those questions, it sounds a little bit like this, and these are my words, obviously. Donald Trump is a Dow Jones kind of guy. He's big business. And typically the stereotype around the Republican Party is they are the party of big business. They are pro-business. Are we saying that he's going to become a Russell 2000 small caps kind of guy? Is this going to be the outlook for the second term of Donald Trump?
You know, I've been spending a lot of time on the tech space and their recent formation of a super PAC, and as you just mentioned, decisions by Elon Musk to donate considerable sums of money over the next couple of months as we go into the final 4 of this election cycle. And what I have to recall every time is the way the trade war was orchestrated, where then Treasury Secretary Mnuchin and Ambassador Lighthizer and others were granting licenses and exclusions that ultimately led to lower tariff rates under Trump than there were under Biden. And I have to translate that to what the business community and the tech sector is seeing right now as the potential. They have an in to J.D. Vance. They have been a part of his campaign since he ran for Senate the first time. I think what the business community, as well as the international community, including the European Union, have seen in the last 8 years is that they can have a more direct line of communication that leads to exclusions, grandfather clauses, and licenses under Trump than they could under Biden. And that explains a lot of it, in my opinion.
That direct line, does that mean that the big business goes to the top of the ticket, Trump, and it's the smaller, maybe smaller tech companies that go to the bottom of the ticket, J.D. Vance?
I think that makes perfect sense, and I think it makes a lot of sense to see how they fill out any potential cabinet secretary positions. One of the things that I focused on a lot this year is the fact that a number of these potential candidates for a second Trump term are not going to be eligible necessarily for 60 votes in the United States Senate to be confirmed. So there might be a lot of acting cabinet secretary officials. those could be more extreme people. And if the administration is not particularly bothered about having an acting secretary for a while, then that's somebody who can have the ear of business, the ear of small business, Russell or large cap names that can get directly in. There are a whole host of ways and anybody that they know. So it makes sense that they get involved now. I would also point out that the Teamsters Union has decided that they are not going to necessarily endorse Biden this year after supporting Democrats for the last 2 decades, going back to Obama in 2008 and well before that. And I think that's a major indicator of how deeply insidious the Republican ticket has been on the Democratic blue wall in Rust Belt states. And J.D. Vance, hailing from Ohio, and the events in Pennsylvania, I think, really serve the Republican Party right now.
Teamsters president last night, I think he had the longest time allocated to him to give this speech. He says we're not beholden to anyone. Is there a potential that we are seeing a shift of pro-labor union individuals supporting Republicans? And this was supposed to be a main pillar of President Biden.
Yeah, this has been going on for a long time. And what's really remarkable is, if you've spoken with anybody in the Biden campaign for the administration for the last 4 years, you know that they have bent over backwards to provide for the labor unions. Scranton Joe talks about it all the time, their trade policies, even to the detriment of the environmental lobbies. And they really try to walk a fine line, but it's not working. The 1.3 million people strong Teamsters Union that's integral to Nevada, Michigan, Ohio, Pennsylvania, they're saying we're not necessarily going to endorse Biden this year. They're not even scheduled to speak at the DNC yet.
Henrietta, somewhere else that Trump and J.D. Vance are very closely aligned is when it comes to foreign policy. Vance speaking yesterday to Fox saying China is the U.S.'s #1 enemy. He gave an interview to Politico over the spring saying that he was for devaluing the dollar. The market, for the most part, has written this off as just campaign rhetoric. Does J.D. Vance as vice president mean you can no longer do that?
I don't think you should have written this off as rhetoric. Regardless, I think the former president illustrated he's extraordinarily clear about his approach to tariffs on China. I think that they are the #1 offset in the tax bill plan. That tax bill will cost $4.6 trillion. So even if you don't believe the rhetoric around the international relations, believe the rhetoric around the deficit. $4.6 trillion just to keep tax rates flat is no laughing matter. I think that depending on the size of any Republican majorities in the House and Senate, you may or may not get the $1.2 trillion SALT tax cap. That would be a major dent in the deficit hike that will be imposed by the 2025 tax bill. And the former president's plan is to impose tariffs in order to offset the cost of that bill. So you're going to need those tariffs come hell or high water. They need the revenue.
We've got to squeeze this in. Last time we spoke, you said there was a really, really strong chance that Joe Biden wouldn't be top of the ticket come November. He'd have to step aside. Events happen. It feels like we've been overtaken by events, particularly what happened on Saturday evening. Have you changed your mind on that call, or are you sticking with it?
I think that the events of Saturday helped former President Trump, secure a lot of groundswell of support and galvanization from his base. And I think it created some breathing room for Joe Biden that is obviously changed the circumstances. So one other thing I would point to is that the DNC is trying to move up their vote count to start July 29th and end on August 5th. So there are a lot of things working in Joe Biden's favor right now as well.
Henrietta, we appreciate your time. Henrietta Trace there of Vader Partners, breaking down a situation in the Republican Party and the extra time that the sitting President Joe Biden's ultimately been granted here.
He has been given a lot of time, one, because that interview yesterday started, of course, with the attempted assassination attempt on the Republican candidate, Donald Trump, and the former president, but also the VP pick. It's sort of taken the oxygen out of the room, given Biden this breathing room to not face the calls every day of, well, this is potentially a make or break interview. This is potentially a make or break campaign stop. He was defiant yet again in the interview last night. Even though there was times he struggled to form his sentences, remember exactly what he said, he was still defiant, which is why the whispers are quiet right now.
Sure.
I don't think they've gone away.
Look, if we didn't have the events over the weekend, let's just make that assumption. I know that's tremendously difficult to do. Let's just say we had that interview yesterday evening and the president delivered his responses in the way that he did. We'd have more House Democrats this morning asking him to step aside, without a doubt.
Absolutely, because they would have felt emboldened once again that this performance was not good enough for the job to be president of the United States.
That's the latest in Washington. Here's the latest elsewhere with your Bloomberg Brief. Here's Yahara Hakes. Hey, Yahara.
Hi, John. We start with Bank of America. Those shares are up in the pre-market. The company reported trading revenue, excluding DVA, in the second quarter that beat analyst estimates. Bank of America also reported investment banking revenue that came in above estimates. There was also some insight into the health of the consumer. BofA said net charge-offs increased by more than 76% due to, quote, higher credit card losses. Sagenti Capital Management has returned more than 90% of its clients' capital less than 2 months after it told investors it would shut the firm and return their money. The multi-strategy hedge fund had about $4.7 billion under management at the end of May. This coming as its founder, Simon Sadler, and ex-trader Daniel LaRocca will be going to trial over accusations of insider trading. And Match Group, the owner of the dating app Tinder, is facing its third activist investor this year. Starboard has built a stake of more than 6.6% in the company, according to a letter reviewed by Bloomberg. The investor plans to push for a sale of Match if the company fails to turn around its operations. This coming as online dating companies have been struggling with slowing growth and challenges in retaining paying users. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, the big rotation.
I think the big question is, as we get this rotation, can it occur without selling of big cap tech to buy small cap? Does AI continue to lead the way, or do we get a rollover?
We'll continue that conversation next. Live from New York City this morning. Good morning.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equity futures on the S&P 500 firmer here by 0.1%. The outperformance once again this morning. It's on the Russell, the small caps rallying big time. Under surveillance this morning, the big rotation.
As we come into earnings, I think the big question is, as we get this rotation, can it occur without selling of big cap tech to buy small cap? Does AI continue to lead the way, or do we get a rollover? And if we roll over, I think that's going to be so much pressure that even if small caps outperform, it's going to be in a down market rather than an up market.
So here's the latest. The rally in small cap stocks showing no signs of slowing. The Russell 2 tech names don't do fine. But at least for now, they have been trading a given valuation, might continue doing so. Dan joins us now for more. Dan, good morning to you, sir. It's good to see you.
Thank you for having me, sir.
Anytime. Let's start again. Good morning, Dan. It's good to see you.
Thank you for being here.
Anytime. Thank you, sir. Let's get into this.
Sure.
Small caps outperforming. A lot of people drawing the line to what's happening politically in Washington, particularly at the RNC overnight. Do you think we're reading too much into this?
Well, I don't think the small cap move really has too much to do with the RNC per se, and frankly, I don't think anything really has too much to do with the RNC at this point. Listen, the small cap story was one that a lot of us were talking about. Not small cap, the non-mega cap story was one that a lot of us were telling coming into the year, that if you'd asked me, and people did, coming into the year, would I rather be long the S&P 493, so to speak, or the Mag 7? And my answer was the 493, and of course that has not proven to be accurate. Small caps would fit into that discussion as well. The problem there is that you had that inflation interruption in the first quarter when you got a couple of 4/10 readings, and that put off any rate cut discussion. Now that that discussion is not just re-emerged, but in full swing, you're starting to see the type of action that people such as myself thought might happen to start the year. So I think that's largely speaking what's going on here.
So you don't think this is just a position squeeze? There's something fundamental. There are some tailwinds that might be durable through this year.
Listen, there's always a position squeeze, and I think that's, you don't get the type of parabolic, dare I say, action that you're seeing right now without some positions being squeezed. But if you're asking me underneath it, is the reduction in rate expectations, the inversion of the curve, so to speak, does it all play into the idea that that small caps might do okay-ish relative to large caps in the immediate future? I think the answer is yes, there is something fundamental there. Now, admittedly, I would say I don't love the small cap index and never have. I don't think most viewers can name 10 of the top 100 companies. Sure, Abercrombie's in there, and Sprouts Farmers Market if you're an organic guy like me. But other than that, I don't think most people know a lot of those companies. I don't think they're particularly emblematic of any larger economic play, if you will. But to the extent that you think that these companies, and they are, more levered to floating rate debt, more debt in general, et cetera, a reduction in rate cut expectations is surely going to benefit them. And again, I think that's what's going on.
You don't strike me as someone who spends a lot of time at Abercrombie & Fitch. Just a hunch. I know we've just met, but...
Well, ever since they got rid... No, I can't make the inappropriate...
Well, okay, fair enough. Okay, but you're talking about the positioning squeeze being part of it. But where we've seen that squeeze is on the most shorted stocks, on the small caps, on the unloved stuff. Where we haven't seen the squeeze is the over-positioning of the Mag 7. Those have mostly remained flat as the rest of the market has been catching up. Can that remain the trade?
Yeah, listen, I think, first of all, if you look at Apple and Tesla in particular, they are overbought and certainly are, like small caps, probably in need of a breather here. I think there's an argument that from a money flow standpoint, money can come out of the mega cap, so to speak, and into the rest of the market without there being a huge dislocation in the indices. But at the same time, if you're going to have some sort of a decline, obviously in NVIDIA, Apple, et cetera, then for the most part, no matter how well the rest of the market does, at best you're going to trade flat. At worst, you're probably going to trade down a bit, even if underneath the headline things look a lot better than the headline suggests, akin to the way right now that the broader market isn't doing quite as well as the headline is suggesting.
I wonder if earnings can help us here, because Bank of America points out that Mag 7 earnings are going to slow down for the first time in some time from a high base, and the 493 are going to catch up again from a low base. Will that help some of this rotation?
I think it should. I don't think most people realize that we've had probably 4 or 5 quarters now where ex-tech, ex-financials, of course, but ex-tech, ex-Mag 7, ex-financials, you basically had flat to down earnings for, again, as I said, about a year and change now, 4 or 5 quarters, and you're just now starting to come out of this earnings recession. That should bolster the case for the rest of the market. To be clear, for Solus, we're nowhere near the mega cap names. We're scouring the market every day for both credit and equity for names that are unloved, that are overlooked, and there's a whole large portion of the market that is both unloved and overlooked. And I think there's ample opportunity here, and you're starting to see it peek its head out right now.
So you don't think the RNC, or maybe Trump's pick of J.D. Vance, is fueling small caps, but can we talk about what this ticket could potentially mean if we were to get Trump Volume 2? What kind of policies are you looking at and potentially investments you would want to put on?
Yeah, so I think we were just saying, you might say, well, energy is going to do great because Trump's going to drill, baby, drill. But I don't think most people realize that during the first Trump presidency, energy stocks were among the worst performing sectors. And during the Biden administration, which is perceived to be obviously more onerously regulatory of the energy environment, that energy stocks have been among the best performing sectors. So it's never so simple as just X is going to happen and therefore Y. That said, I think forgetting J.D. Vance for a minute, because I think Trump is obviously, as you well know, ideologically set, and I don't know that Vance necessarily moves the needle policy-wise, but The tariff story is probably going to be the big one that we have to wrestle with. I think we can assume that if Trump wins, probably the Senate and the House goes with him. And if you have unified government, you'll get the extension of the tax cuts. That's 3 to 4 trillion or so. So deficit and debt issuance is going to be a story. But the tariff is one we're going to have to wrestle with. I imagine the 10%, 60% discussion that's ongoing is a starting negotiation. But at the same time, the idea that tariffs are going to be put in place is probably something that's going to happen, the degree of which is an open question. What does that mean? I think it's certainly inflationary, all else equal, but is it necessarily bad? What sectors, what industries? That I think is going to be the largest conversation, at least initially.
We shared this earlier this morning, the Bank of America Fund Manager Survey. If we get the sweep that Dan is talking about, 77%, Danny, say higher bond yields, 52% say a stronger dollar.
Listen, I was talking to somebody just before coming on air.
Dan, I was speaking to Danny.
Yeah, we sound the same. Come on.
We look alike. We have a similar name.
Music's playing, Dan. We're going
You
to
just
break.
take the eye away.
You guys go. You guys go. I'm monopolizing the time.
I think Dan stole my thunder.
Dan Greenhouse, thank you, sir. We're out of time. Up next,
And I don't even
he's
get
so
to
rude.
answer.
Maybe you'll be back, maybe you won't. Coming up next, Robert Koenigsberger of Gramercy Funds on the Trump trade. From New York City, you're watching Bloomberg Surveillance.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Waiting for numbers from Morgan Stanley. As we wait for them to drop, let's check out the price action. Equity futures on the S&P 500 up a tenth. Once again, Danny Berger, the outperformance on the small caps, the Russell, up 1 full percentage point.
There's a lot of things going for the index at the moment. A lot of the strength came post-CPI when we say, okay, maybe rate cuts haven't fully been priced into this, but you can't ignore the politics of it all. When you look at things like smaller oil and energy companies doing better, financial companies doing better, Jeffrey's out with a note saying that it is financials that are looking forward to a deregulated, more M&A-friendly environment.
Regional banks have absolutely surged up double digits over the last 5 days. Speaking of the banks, numbers from Morgan Stanley. Let's get to Bloomberg's Sonali Basak. Hey, Sonali.
John, when you look at some of the core numbers here, particularly those Wall Street numbers, we're looking at the trading desk. You do have equity sales and trading coming in above estimates at $3.02 billion. The estimate was for $2.7 billion, so meaningful beat at that equities sales and trading desk. You also have the wealth management revenues not as bright. You have them missing estimates to the tune of about $6.8 billion. The estimate was also 6.8, but 6.86. We got in at 6.79. Let's see if the market gives them a hard time. The beat, though, you also see here on net interest income is meaningful for Morgan Stanley. Of course, Morgan Stanley has been trying to lean into more of that lending revenue at its wealth manager in particular. You also see FICC sales and trading revenue beating estimates, coming in at $2 billion. That is a business that has been growing meaningfully over time at Morgan Stanley. Interesting, the rat race is over. We have all the numbers from the biggest banks. You do even with a beat over at equities trading. Goldman took the crown once again when it comes to the equities trading number there. We'll keep an eye out on how the stock trades, but again, you do have Morgan Stanley rising pre-market on those beats about 2% or so higher.
Sonali, you said it. That wraps up Q2. We've had all the big banks, the big players report. You typically grade them. Who won Q2?
It's hard to not say that JP Morgan won just because of how far they came in their returns on equity, their returns on tangible common equity of 28% in this environment, John, an environment where people are worried about expenses. Their net interest income of $22 billion, Bank of America, $23 billion nearly. Bank of America, Citigroup bought in about $13 billion. They're guiding higher for the year. Story gets really interesting when you think about those rate cuts and how that might impact these banks moving forward.
Sonali, Morgan Stanley up in a pre-market by a little more than 2 full percentage points. Sonali, thank you. Under surveillance this morning. That wraps up bank earnings on Wall Street. Bank of America a little bit earlier, delivering better than expected net interest income and trading revenue. As Sonali broke down just moments ago, Morgan Stanley reporting a beat on equity trading revenue, but a miss on wealth management net revenue. Elsewhere, another story to look at. Former UN Ambassador Nikki Haley is expected to speak at the Republican National Convention later on today. Donald Trump reportedly called Haley his one-time rival after he was shot on Saturday to invite her to the convention. Last week, Haley said she was releasing her delegates and encouraging them to support Trump. New tariffs of 60% on Chinese exports to the U.S. would more than halve China's growth rate, according to new research from UBS. This comes after reporting earlier this year that Donald Trump is considering a flat 60% tariff on Chinese goods. To discuss, Robert Koenigsberger of Gramercy Funds Management joins us around a table. Robert, good morning to you, sir.
Good morning.
Big tariffs we could potentially face. I think we've all sort of got volume one, Donald Trump down. We understand it. Tariffs, what it means for the world. If we think about the arc of that tariff effort, initially there was a big focus on things like NAFTA. It was about Mexico. Then it was China later on. What do you think the arc is this time around? How are you thinking about things in EM?
Well, I guess it is helpful to go back and look at what happened in 2016 in EM as Trump came in. And I think there's a couple lessons. One was this immediate trade-off of the markets and with very little differentiation, perhaps a little more impact on Mexico than elsewhere. But if you look from November of 16 to by February 17, so 30 days after Trump had been in, all of that down trade had been recovered, and it was all in positive territory. Now, of course, 16 perhaps was a bit more of a surprise, the Donald Trump victory, than perhaps it might be in 24. So a lot of the Trump effect is starting to be priced into markets already. You saw that in the steepening of the curve yesterday. So as we go forward, I wouldn't be surprised to see some volatility, but I think you're going to see some differentiation between Asia and particularly China and Latin America.
Are you seeing that differentiation yet? Are you hearing that as well?
Starting to, but again, the China trade and the headwinds of China and tariffs, all that, I think it's been, more properly priced this time around.
Who would benefit outside of the United States if actually you were to see manufacturing come back to the U.S.? Who in EM would benefit from this trade war, which potentially we're going to get?
Sure, I think you'll continue to see a trend that's underway, and Mexico's a big winner. And we have a large private lending business in Mexico, and we've seen a lot of opportunities that have come out on the onshoring and the nearshoring in Mexico. Obviously, India has also been a big beneficiary, but I think when I look at LATAM today, you could say LATAM is going to be a winner, but I think you can also start to differentiate the different regimes and those that look more to the right, more to the left. And I think it's going to be beneficial for the Argentinas, maybe even the El Salvadors, maybe a little more challenging for Brazil and Colombia.
When it comes to Mexico, though, doesn't Trump need to make sure that there isn't a back door for Chinese companies to still they're exporting into the United States just under a different flag? Yeah, I think that's a great point. A friend of mine who has been doing manufacturing in China for 35 years in textiles just made a trip to Vietnam. And he said, because all of the businesses has moved to Vietnam. I said, well, that must be a challenge. He said, well, it's all the same people. They're just moving to Vietnam. And I think you're seeing that in Mexico as well. It's going to be one of the challenges that are faced.
And I think that's an excellent point, that it's not just Mexico. It's elsewhere in Asia, too, which leads to the confusion, the unknowingness for 2025. What does that mean just in terms of investment and businesses willing to make these sorts of deals, to do these sorts of partnerships, when we just, frankly, to your point, don't know what it will look like?
Yeah, I mean, I think it's about trying to tease out where you can have the best conviction. And in our world, it's about trying to figure out how to be beta agnostic and really structure investments, transactions, what have you, so you can be more agnostic to those risks. One have to expect the risks. There's a lot of unknown knowns and what have you. And so it's all about the structure. It's all about the detail. And the devil's all in the details and how you negotiate a contract, how you implement a contract, whether it's on financial investment or direct investment.
Well, it's this tension we've seen play out in markets over the past week, this push and pull of, do I care about the economy or do I care about politics? Where do you stand on the spectrum right now?
I mean, I think ultimately the economy matters. And when I look at different regimes in Latin America, for example, you can see all sorts of volatility around the politics. But oftentimes, if the economies themselves are anchored, you can have change in politics, and politicians, but you have a change in regime. And if you have regime change, then you should expect policy change. But oftentimes, it's not the regime that's changing, it's just the name of the leader.
Let's talk about regime change, actual regime change, and just the typical market characteristics of things like treasuries, DM versus EM. My cheat guide, and you're the professional, not me, but my cheat guide for the distinction between the two is often what happens when things go bad. In EM, you sell it. In DM, you buy it. That's what happens with treasuries. We used to see that in Europe, particularly in bonds. Things have changed a bit in Europe. I want to understand if things change here in America. When things start to go bad, whether it's the economy, whether it's politics, whether it's governance issues, do treasuries rally anymore? Do they start to behave like EM? Are we turning the world upside down?
Yeah, I mean, these are great points. I mean, if you look at, in the post-COVID era, I think EM led the way in terms of good policy vis-a-vis the U.S. and some of the developed markets, raising rates faster. And, they didn't have the flexibility that some of the developed markets had. But, I guess when you look at the U.S., I mean, you start to think, well, what's the alternative, right? And that's the problem. There's fundamentals and then there's technicals. So where are you going to go? That's the challenge.
Is there anywhere in EM that you'd suggest you could go?
Yeah, I mean, I think it's, for us, it's less about where in EM and how to approach EM.
Talk to me about that. What's different about the approach?
Yeah, I mean, I used the notion of beta agnostic before, and we're just talking about policy. But I think, within emerging markets, I think you can go in and get the high expected return without making a call on beta and do it by kind of this active tacit asset allocation. And really anchoring in high conviction yield, owning things that you want to own, not owning an index because JP Morgan told you to own a certain credit. And then waiting for opportunistic credit when it's really opportunistic, special situations when they're really special, and distress when it's really distressed. And I think, we've seen a lot of mistakes that folks have made in emerging markets for 25 years. It's usually about buying the wrong thing at the wrong time, sticking with it for too long, and then capitulating, and then wondering once again why it didn't work. And so we think there's a better approach to less about making a call on the asset class. You think about it, when you talk to your guests about developed markets, it's not about yes or no DM. It's about how to play it at any given time. But EM tends to be this afterthought. Should we be in or not? Should we be in beta or not? And we think that's one of the big mistakes that folks have made historically.
When you say special situation, describe that to me. In the past, historically, what has been a special situation? Said, this is really special, I got to go in.
Sure. I mean, special situations can be anything as simple as some of the sovereign debt restructurings that we've been involved in for the past, 35 years as individuals or 26 years. Some of the special situations that we're involved in today, for example, may be around late-stage litigation finance, both in emerging markets and out of emerging markets. And what makes them special is you're able to structure the transactions, get a really high coupon and return, but we've been able to do things like wrap it with insurance to be able to get principal protection or even minimum returns. So you create these asymmetric return profiles that look more like call options than bonds.
When you look at the United States and you say, well, there's really nothing else that is on the same caliber, do you think we're at peak U.S. exceptionalism?
That's hard to call. I mean, I think I think there's cycles and wanes and what have you. I think for this cycle, the exceptionalism has been pretty strong. But again, I'm not sure where it's going to come from in the short term.
I want to ask you about China specifically, because we've been getting a lot of data over the past couple of days, and it does paint a dour picture. Consumer who still isn't picking up, soft GDP numbers, despite continued exports of things like EVs and semiconductors. That's been the model. No support overall, but continue to pump out goods. Is there a limit to how much that can help China in the recovery?
Yeah, I mean, I think the elephant in the room for China is the property sector, right? You got to go back to the Evergrande crisis, and I think the goal of the government was to isolate Evergrande and insulate the rest of the sector. But again, real estate's 25-30% of GDP. So to ignore, everyone keeps waiting for the bazooka. There's just been little drips of aid, but to ignore 25 or 30% of the economy is just doesn't make sense.
Well, we've been waiting for the bazooka for how long? I mean, that turn of phrase, we've been using it for so long. Isn't there a certain point where these drips add up to something? I mean, why is this so chronically underloved in a struggling sector when there has been support, and you could argue things have been adding up?
Well, I think if you look at some of the data, even this morning in the housing sector, if you look at the year on year, it still looks pretty anemic. But we're starting to see a bottoming out and actually small growth on month to month. So it's all about confidence, right? I mean, there's certainly an inventory overhang. You mentioned, this export-oriented economy. Well, that's not creating a lot of confidence for the consumer. And the consumer's got problems in real estate, but they have problems in employment and elsewhere. So it's complicated.
Can I just finish with your conviction trade? The way you described EM, I think it's really interesting because that's typically how we all talk about it. On or off, long or short, in or out. It's very, very binary. What's your number one position right now that you're super confident about and telling the world all about? What is it right now?
Yeah, I mean, and we've talked about this in the past, but I think the special sauce in emerging markets today, at least for us, is the ability to do private credit, asset-backed lending, like developed markets 10, 15 years ago, where you can go in and get high expected returns. You can mitigate your risk through structuring and collateral. Take a quasi-sovereign oil and gas in Latin America. A bond maybe trades at 5%. It's got collective action clauses. It's got trustees. It's got all sorts of challenges. You can lend to the suppliers of that same company, get the company guarantee, and then go and get uncorrelated collateral, hotels, shopping malls, whatever it may be, and get 1,000 basis points, 10% more yield. I'd rather do that all day long and not have to figure out the hardest thing to figure out, which is beta.
Robert, super smart and wonderful to hear from you, sir. Thank you. Robert Koenigsberger there of Gramercy Funds on emerging markets. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's get across to Yahara Hackers. Hey, Yahara.
Hi, John. Let's recap those Morgan Stanley earnings. Shares are lower in the pre-market. A miss on second quarter wealth management net revenue, overshadowing a beat on equity trading revenue. The bank's CEO, Ted Pick, saying it remains well-positioned to deliver growth and long-term value. Earlier, Bank of America reported better than expected net interest income and trading revenue. Verizon is exploring the sale of thousands of mobile phone towers across the U.S. That's according to people familiar with the matter. They say the biggest wireless carrier in the country has hired advisors to gauge interest from potential buyers. A sale could bring in more than $3 billion for the phone company, which declined to comment on the report. Back in 2015, Verizon sold the right to lease and operate about 11,000 towers to America Tower Corp for $5 billion. And in a home run derby first, a Los Angeles Dodger has taken home the trophy. Outfielder Teoscar Hernandez won the showcase event last night in Arlington, Texas. He beat out Kansas City Royals rookie sensation Bobby Witt Jr. in the final round, 14-13. New York Mets All-Star and two-time Derby champion Pete Alonso was eliminated in the first round. The festivities culminate tonight with the MLB All-Star Game. That's your Bloomberg Brief. John?
Yeah, all right, thank you. The only thing I heard about this was the national anthem. Did you hear about this?
Oh, that it was like the worst national
Apparently
anthem ever to be sung?
I've not heard it yet.
God,
I'm going to do that in a commercial break.
Don't
you
do
heard
it.
it
I feel
yet?
bad for her. No, don't listen.
Was it
Don't
her?
do
I've got no idea.
Yeah, it wasn't.
Okay.
It wasn't good.
All right, still going to listen to it in a commercial break. Up next on the program, Donald Trump picks J.D. Vance.
President Trump was right about every single disaster that Joe Biden was wrong about. NAFTA destroyed the manufacturing economy in Pennsylvania, Michigan. A real estate developer from New York, Donald Trump, was actually right about that issue.
That conversation up next from New York. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
For the record, you might have guessed, I can't sing. I can't sing.
Neither can I.
I can't sing. It's pretty bad, all right? It's pretty bad.
I feel bad saying it, but it is pretty bad.
Yeah, that
Maybe
is not good.
Couldn't hear
rendition.
herself. I honestly feel so bad for her. It's painful.
Okay, it's pretty painful.
It's painful that because John mentioned it, I had to go listen to it, and I'm never going to get that minute back in my life.
We can't sing. None of us can sing. Apparently, she can't either, all right? Equity futures on the S&P. That was a bit harsh. That's a bit harsh. Equity futures on the S&P firmer by 0.1%. Under surveillance this morning, Donald Trump picking J.D. Vance.
President Trump was right about every single disaster that Joe Biden was wrong about. NAFTA destroyed the manufacturing economy in Pennsylvania, Michigan. A real estate developer from New York, Donald Trump, was actually right about that issue. Letting China into the World Trade Organization. Joe Biden supported it. A real estate developer from Queens named Donald Trump opposed it.
So here's the latest. Donald Trump picking Republican Senator J.D. Vance of Ohio as his running mate. Once a critic, now fierce defender, Vance is known for his populist policies, the 39-year-old calling for increased tariffs, stricter banking regulation, antitrust enforcement, and has been very critical of aid to Ukraine. So when you see this picture in the equity market, the S&P up just 0.1%, the Russell of small caps surging once again, this time by 0.9%. How much of this picture is really about the prospect of another round of Trump policy? Let's get into it. Chris Verone of Strategas, a Baird company. Chris, good to see you, sir.
Great to be here.
Big rotation underway. Some people trying to work out, is this just about rates, about the economy? Is it also about politics? Where do you stand on that?
I think, when you look at what's really driving this move, financials as an example, I think it's a combination of really three things. Certainly the move in rates, I would put at the top of the list here. This is a very, very big breakdown in two-year yields. Look at the UK twos this morning, breaking below 4% for the first time in maybe 2 years. So there's certainly a rate element to this. There's the political side to this as well. And as we know, I think this is a market that's pulling forward a Trump win. The leadership profile looks remarkably similar to what we saw in the weeks following the 2016 print. So you have that as well. Then you have, I think, the macro, which I would describe as still certain sectors justifying the soft landing call. I think financials, when you look at the past soft landing, 1995, they were the big winner. So their leadership here, I think, speaks to this really threefold story. You have political, you have soft landing, and you have rates down. I think that's really catalyzing this leadership.
Politics, rates, macro.
Yeah.
Of those three, do you think some are more durable, sustainable than others?
I think the rate story is the most important of this. I think it's the most durable of this. We have put a major top in bond yields. We're going to 350 on two-year yields. We're going to maybe 3.25 or 350.
You say that with conviction, like you know. Where does that come from?
I'm a trend follower, and the trends have changed all year. Really, for 6, 7, 8 months, these have been trends that have been transitioning lower. And when you look at the global picture as well, yields are breaking down everywhere. German 10s have failed here again. The UK 2s, the Swedish 10s, the US 5s, the US 30s. Something has changed meaningfully in the bond market.
Even so, we're still expecting 2 rate cuts this year. If we're talking 50 basis points, how much is that really going to help a sector like the small caps? We have all this floating rate debt. Is 50 enough to really revive the trade?
I think we're in a little bit of a reverse situation from late 21, where, frankly, the market began to demand rate hikes. I think the market is now going to start to demand rate cuts. I mean, the two-year yield right now is trading basically 100 basis points below Fed funds. Even after the ECB cut a few weeks ago, German 2s are trading about 100 basis points below the ECB policy rate. The market is demanding, I think the Fed is going to do more here.
Okay, so in that world where the Fed does do more, in terms of the sectors themselves, if you look at something, again, like a small caps, where we're heading towards a soft landing, they're okay. What in there makes sense to you? Because to John's point, it has been the policy that's been leading it. It's been the financials. Is that what leads this?
Well, it's the largest weight within Russell 2, so financials participating certainly helps the story. But think about the inverse of this for a moment. When you had the non-recessionary rate cuts in summer 95, what worked and what didn't work? Financials roared, tech struggled. Lower rates were not a boon to tech. And, I think some of the best clues that markets give can often be very subtle. The last 3 or 4 weeks, even before last Thursday, banks were breaking out. Semis were not making new highs. NVIDIA, Qualcomm, AVGO, Micron, they all peaked back in the middle part of June. Those last 3 or 4 weeks, they were not involved. Watch these stocks here. We know how robust the enthusiasm has been. We know how massive the flows have been. They're starting to crack here a little bit. All these AI-related power stocks have also started to crack here the last few weeks. So I think lower rates will not be the boon to that group that perhaps many expect. I think the financials are telling you that's where the momentum is.
Let's talk about the politics.
Yeah.
When Trump won in 2016, he came out, he was talking about infrastructure. And then it became an ongoing joke in Washington, D.C. Everything was infrastructure week, and then actually took Joe Biden to get a bipartisan deal done. With that said, if you're bringing forward a Trump trade, what are the risks that actually you're wrong, this does not pan out?
I think the risks are that the bond market is telling you that 2 feet are coming off the accelerator next year. And what's underpinned, I think, a lot of the economic momentum has been stimulus over the last year plus. And you begin to wonder if, first year presidential cycle next year, if it's a change in administration, does the foot come off the accelerator, particularly on the fiscal side? Is that what the bond market is starting to reflect and pick up? And remember, this is a yield curve that's steepening. We know what the historical message of that is. When you start to get a curve that's been inverted for a long time come out of inversion, it typically means you're not too far off from some recessionary environment. So I think that has to be a risk for 2025. First year presidential cycle tends not to be particularly good either. I think in the interim, I think we have 4, 5, 6 months here where this market's still in good shape.
Just to get into that a little bit more, does it matter how the curve steepens?
Absolutely.
Because the kind of steepener that you're talking about, I think, is the bull steepener, the rate cutting cycle.
Yeah.
That wasn't yesterday.
I mean, 10-year yields are now below where they were at yesterday's low.
Granted, accepted,
right?
Valid point.
Twos have gone from 5 and change to 440 and change. Sounds like a bull steepener to me.
That's what you're looking for.
That's what I'm looking for.
Donald Trump doesn't change that.
I think it accelerates it.
It accelerates the bull steepener. Okay. Get into that. Tell me why, because a lot of people might think more supply, inflationary presidency, longer end sales off. Why does it accelerate the bull steepener?
If you remember November of 16, you got a bear steepener out of November of 16 as the market began to price in kind of economic reacceleration, deregulation, all of that. There's a lot of equating of what we've seen with this steepener the last couple of weeks, really post-debate to that moment. But the subtle difference, as you know, John, this has been a bull steepener. Why has it been a bull steepener? Because I think the market is beginning to pick up the idea that you're going to lose some of the fiscal support in 25 that you had in 24 and 23. And I think ultimately, at the end of the day, it means nominal bond yield lower, particularly on the short end. You could convince me maybe 10s and 30s hang out around here, but I think we've lost twos. I think we lost twos for this cycle.
But you just said Trump presidency might accelerate it. I want to understand why. Why would it accelerate that move?
I think the likelihood that we have the same fiscal impulse in 25 that we had in 24 is low. And I think, therefore, the message of the bond market is one of slower growth, not more robust growth. And I think the short end reflects that.
Okay. Chris, good to see you.
Always a pleasure.
Super smart, as always. Chris Ferrone of Strategas, a Baird company, on that steepener, looking for that bull steepener to continue.
That feels quite contrarian at this moment. I mean, it's
that's out of consensus.
Well, considering that it is a market that has not been trading that way at all, has been a bit. But I think, to Chris's point, you need to rethink a lot of things. If that is the case, you need to rethink this equity market. You need to rethink the health of big tech in that environment. Again, if low yields also means they're not doing well, I think we got quite a few things to reckon with.
We've got a lot to talk about this morning and maybe for the rest of this year. Coming up on this program, Republican Congressman Mike Lawler of New York, Greg Dacko of EY, and Andrew Husby of BNP Paribas. More still to come from New York, the third hour of Bloomberg Surveillance, up next.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
The conventional wisdom right now is going to be that this is Trump's election to lose.
Joe Biden and his campaign, even with all of the dysfunction, should not be counted out just quite yet.
There isn't a Trump trade or a Biden trade. You have to put Congress in the mix.
U.S. assets are probably likely still going to be attractive to the global community.
I think geopolitical risk continues to ramp up this summer.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now with equity futures on the S&P firmer by 0.1% after a major rally in this equity market over the last week. We'll dissect that rally in just a moment. In about 30 minutes' time, retail sales in America, the data point to watch. Chairman Powell says he's a little bit more confident about the trajectory for inflation. We want another read on the U.S. consumer. And then later, an address by Nikki Haley, of all people, at the RNC in Milwaukee, Wisconsin. A preview of that a little bit later on the program as well. The challenge we've all got in financial markets right now, look at the outperformance in small caps. How much of this is about the macro backdrop, the rate story, the politics? I want to sit on the politics. The challenge I think we've all got right now and for the next 4 months, the difference between how Donald Trump will campaign and how he might govern.
Well, and also now who his VP pick is. This is someone that around this table we've almost coined king of the small cap, someone who likes small business, does not like big business, does not like big tech. And that pick yesterday from Donald Trump signifies the not just tilt toward the populist wing of the party, it's a full pivot, which is why this evening is going to be so interesting, because there's a big gap between the Nikki Haleys and the J.D. Vances.
I also think on foreign policy, J.D. Vance is a big signal in how he's going to govern. Speaking to Fox yesterday, saying that China is the U.S.'s #1 threat. He also spoke to Politico over the spring, saying that he's all for dollar devaluation. So a lot of this, which the market has said, is just campaign rhetoric. It's going to calm down. I think if you have another guy in office alongside you who believes exactly the same thing, it's hard to just say, it's just rhetoric.
Yeah, so this gets really tough. Let's go to the fund manager survey from Bank of America, and we'll go through those stats for you again. This according to their survey. What happens if you get a sweep? Red or blue? This is what people think. 77% say higher bond yields, 52% say higher US dollar. It's the dollar piece of this that I think gets interesting. If you're saying that basically Senator J.D. Vance does not want a stronger dollar, and most people in foreign exchange markets come on this program and say, if you deliver those tariffs, that's what you'll get, what will they do?
Well, they only have so much power to devalue the currency when they want to do things like, again, tariffs, when they are all for kind of building up the economy. That's such a huge part of their platform, especially when you're talking about small businesses. Devaluing the dollar only goes so far at this point, not to mention that J.D. Vance is going to have to go out to the Senate and kind of whip everybody up out in Congress and say, hey, believe in our policies. A lot of people in the Senate don't like him, both from the GOP and from the Democrats. He opposes a lot of them.
What happened to King Dollar under Larry Kudlow? I think this is where there's some contradictions here that we need to figure out what this is actually going to look like going forward, which is why, once again, I think it's tremendously difficult to work out how different campaigning might be from how they might govern over the next 4 years if they can.
And it depends also if they're going to bring the likes of individuals like Larry Kudlow back into this kind of administration. I'm glad you brought up the Senate. I was shocked yesterday. Well, I guess not that shocked given this full pivot to the populist wing of the party. But when your Senate Minority Leader, Mitch McConnell, was on the floor, he was booed yesterday. Foreign policy is going to be incredibly interesting today. He's a foreign policy hawk. He wants to give more money to Ukraine. This is Senator McConnell. So does Nikki Haley. That is something J.D. Vance does not want to do.
The Haley address, one to watch a little bit later. Let's get to the price action. Equity futures on the S&P 500 firmer here by 0.2%. That's the equity story for the big caps, for the S&P. The small caps outperforming once again. We talked about that bond market sell-off just yesterday. Well, there's a rally this morning. Yields are lower by 5 basis points. The 10-year 4.1750. Coming up in the hour, we'll be catching up with the Republican Congressman Mike Lawler on enhanced security for presidential candidates, Greg Dacko of EY with retail sales 30 minutes away, and David Rubenstein on Powell's growing confidence in 2% inflation. Under surveillance this morning, dissecting a security failure.
Ultimately, this is going to fall in the Secret Service. What were the manpower requests and were they granted? What was the timeline for the agents who were arriving from out of town and being briefed? For my 22 years, I don't think I ever worked a site where I felt like, yeah, we got plenty of people here. There's always holes to plug.
There were some big holes on Saturday evening. Here's the latest. Officials trying to piece together Saturday's security failure at Donald Trump's Pennsylvania rally. Secret Service Director Kim Cheadle telling ABC there will be immediate changes, including expanding tactical support for Trump. This is two New York Congressmen, Mike Lawler and Richie Torres, are introducing bipartisan legislation that would increase protection for presidential candidates Trump, Biden, and Robert Kennedy Jr. I'm pleased to say that joining us now is Republican Congressman Mike Lawler. Congressman, thanks for sharing some of your time this morning, particularly how busy things have been for you over the last couple of days following the events of Saturday evening. Can you walk us through just the content of your bill and the kind of changes that you'd like to see?
Well, we're working through the logistics right now and plan to introduce this week. But the intention here is to ensure that President Trump, President Biden, and RFK Jr., whose family has twice been victim of political assassination, have enhanced security. Obviously, as more information is uncovered about the events on Saturday, it raises serious questions about what level of security the former president had. The fact that a armed shooter was able to get on a roof with a clear line of sight at the former president and get a shot off that went through Donald Trump's ear, but not for the grace of God, we'd be having a very different conversation right now. So, the fact that this was able to happen, there's been lots of questions about, the lack of resources, the lack of air support, if you will, as well as the use of drone technology. Lots of questions being raised that require immediate and serious answers. And this cannot be a, cover your own ass situation. This has to be a full and transparent investigation into what happened, why it happened, and how to ensure that this never happens again. Our elections must be determined by votes at a ballot box, not by violence at a rally. And obviously, the Secret Service has a responsibility to ensure the safety and well-being. And this cannot be a question of expense or resources. The federal government has a responsibility to ensure the safety and well-being of these candidates and to ensure that every resource necessary is available to them.
Congressman, I think many of your colleagues on the other side of the aisle also agree with you. But just from a logistical point of view, how quickly can this bill get passed and then we actually see those resources hit the ground?
Look, obviously, this is a question for leadership on getting this bill to the floor as quickly as possible. I'm heartened to see that the Biden administration did move yesterday to give RFK Secret Service protection after many months of him requesting it. And obviously, the head of the Secret Service saying that there's going to be immediate changes with respect to President Trump's detail. But we need to make sure as a Congress that we are ensuring that the resources are there, both financially, and that there is more stringent requirement on providing this security. I mean, it shouldn't have taken a shooting on Saturday for them to realize that President Trump needed enhanced security and that RFK Jr. should have security. That should have been a no-brainer in this heightened political environment in which, look, we're a deeply divided country, and obviously we've seen incidents in recent years, attacks on members of Congress, threats against sitting governors, violence against, the former speaker's husband. So this is critical in this moment that we recognize the seriousness of this, the threat, and that Congress acts both in terms of ensuring the support financially and otherwise for the Secret Service, as well as these congressional investigations that are going to get underway next week when we get back to Washington.
Congressman, given we are a deeply divided country at the moment, following that assassination attempt, the now VP pick of President Trump said that this had ties back to Biden. Do you think that kind of rhetoric is appropriate coming from the VP candidate?
Well, first of all, the investigation obviously is underway. We don't yet know the motivation of the shooter, and that will come out in due time, and we should allow that process to play itself out. I think what the vice presidential nominee was alluding to in his comments is the continued assertion that Donald Trump is a threat to democracy or a fascist, or that if he somehow wins in November, that therefore American democracy is going to end, is destructive. It's destructive to our country. It undermines our democracy. It undermines our electoral process and should stop. And I think all of us can recognize the need to bring down the temperature several notches, to look at the rhetoric that is being used. Both Republicans and Democrats have a responsibility here. In this moment of heightened political disagreement, that we really recognize the importance of the moment. As I said before, our election should always be determined by votes at a ballot box, not by violence at a rally. And all of us have a responsibility to understand that words matter. Our rhetoric can, at times, cause harm, and we need to be clear that we're not going to tolerate it. And I think what the vice presidential nominee was alluding to in that is that the continued effort to somehow say that Donald Trump getting elected is going to destroy our democracy needs to stop.
And Representative, I mean, to be clear, this was, of course, a shocking event over the weekend and deeply disturbing to anyone, but it is not the only case of political violence. You only need to look back over the past few years, whether it be the insurrection on January 6th, whether it be Nancy Pelosi's husband being attacked. I want to understand from you the temperature read that you're getting at this moment in this country, what you're hearing from constituents. Are we starting to dial down the temperature? Does this weekend represent a peak to you, or how concerned are you still of this deeply divided rhetoric that we continue to hear?
Well, if this doesn't shock our nation's conscience to its core, I don't know what would. Look, I've been very clear over the years. I was the first Republican member of the state legislature in New York to denounce the events of January 6th on January 6th. I spoke out when Nancy Pelosi's husband was attacked. In the same way, I'm speaking out about the assassination attempt against President Trump. All of us should be universally clear in this. Political violence has no place in our democracy. There should be no tolerance for it wherever it occurs, whether it's those that, seized control of a federal courthouse in Portland, burned down a police station in Minneapolis, or stormed a Capitol on January 6th. It should never be tolerated or condoned, period.
Congressman, appreciate your perspective. Thanks for making time for us this morning. Thank you, sir. Mike Lauder there. Congressman Mike Lauder on the latest effort to provide extra security to officials across this nation. Equity futures on the S&P positive here by about 0.1% on the S&P 500, with an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Heques.
Hi, John. Shares of Morgan Stanley lower in the pre-market. A miss on second quarter wealth management net revenue, overshadowing a beat on equity trading revenue. The bank CEO Ted Pick saying it remains well positioned to deliver growth and long-term value. Earlier, Bank of America missed estimates for net interest income in the second quarter, but said the key metric would climb by the end of the year. Those shares are higher. GM is backing away from its goal to produce 1 million all-electric vehicles. CEO Mary Barra saying at an event yesterday that the company won't have production capacity in place to build 1 million EVs at the end of next year, which was its previous target. The CEO adding that customer demand will dictate how fast the company can get to the 1 million mark, but for now, she says, they're seeing a slowdown in EV deliveries. And President Biden will unveil a new proposal today to cap rental costs across the country. His plan would give landlords a choice, agree to cap rent hikes at no more than 5% per year, or give up coveted federal tax breaks. The measure would need to be approved by Congress, where it faces steep odds. It would have to pass a GOP-controlled House and win a supermajority in the Senate. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, Donald Trump picks Senator J.D. Vance.
President Trump was right about every single disaster that Joe Biden was wrong about. NAFTA destroyed the manufacturing economy in Pennsylvania, Michigan. A real estate developer from New York, Donald Trump, was actually right about that issue.
Up next on the program, former World Bank President David Malpass from New York City this morning. Good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
It down to the opening bell, 1 hour and about 13 minutes away. Equity futures on the S&P firm are here by 0.1%, and bond yields are a little bit lower. We're down 5 or 6 basis points on a 10-year to 4.1731. Under surveillance this morning, Donald Trump picks Senator J.D. Vance.
President Trump was right about every single disaster that Joe Biden was wrong about. NAFTA destroyed the manufacturing economy in Pennsylvania, Michigan. A real estate developer from New York, Donald Trump, was actually right about that issue, letting China into the World Trade Organization. Joe Biden supported it. A real estate developer from Queens named Donald Trump opposed it.
Here's the latest. Donald Trump picking Republican Senator J.D. Vance of Ohio as his running mate. The 39-year-old supporting increased tariffs, stricter banking regulation, and antitrust enforcement. David Malpass, the former World Bank president, joins us now from the RNC in Milwaukee, Wisconsin. David, it's always wonderful to catch up with you, sir. Thanks for making time for us this morning. This is a man that you know quite well. Walk us through what we need to know and how you think this administration might change, might be different to what we saw the first time around with Donald Trump.
Hi, John. Good to see you. Well, one thing is high energy, so that's going to, I think, help. We need a lot of U.S. leadership within the world. Another theme from last night that was very clear is the working person in America. You know, I'm a nerd, so we talk about median income, raising the median income. That's what I've worked for 40 years. And that means what's the wage of the people in the middle of the economy? How do you get it up? And there was a lot of talk, of course, last night about manufacturing. J.D. Vance is a great choice as you think about how do you get people in jobs in rural areas, in suburban areas that are manufacturing jobs that are making things again. That speaks directly to Michigan, to Ohio, to Wisconsin, to Minnesota, and so on around. I'm from Michigan, and manufacturing is a key part of the state.
David, if I can match that with a conversation on Wall Street, just to get across to here, there are some conversations taking place about foreign exchange. You know Larry Kudlow, you know him better than I do, we both know him well. Larry Kudlow would often talk about the strong dollar policy. You don't hear that so much from Senator Vance. Some might say you hear the opposite. What do you think is going to change on that front?
We saw in the platform that the U.S. is going to protect the reserve currency status of the dollar. That means defend the dollar. You know, I use the phrase strong and stable dollar. That means 50 years from now, you will know that the U.S. dollar is the stable store of value for the world. That's the best thing for manufacturing because you can make the new investments. I think the key is to create an environment where people want to invest in the U.S. There was the Teamsters Union head last night gave a really strong endorsement to President Trump, talking about breaking the political caste system and creating an environment where corporations wanted to be in America because they could produce here. That's going to be especially true of energy. You can create energy and mining huge value in the U.S., and that enables all of the manufacturing and the technology sectors of the country.
What do you make of, though, Mr. Vance talking about, and he's questioned Jay Powell about this as well, the fact that the reserve currency status of the U.S. dollar worries him and the lack of control we have of our own currency. Does that bode with some of the members, as Jonathan was saying, in the former Trump administration, like Larry Kudlow?
I think the Fed made big mistakes. You know, I've been writing about that in the Wall Street Journal for well over a decade. The idea of having 0% interest rates didn't defend the dollar, and it didn't work for getting investment into the U.S. So you can have a much stronger policy from the Federal Reserve. I think that's some of what people are getting at, that the Fed needs to be talking about production in the U.S. as a way to bring down inflation, and that will bring down interest rates. So I think there is a huge complaint right now that interest rates are the only tool being used to try to bring down inflation. That's not the right way to go at it, and it means that the little guys, small businesses across the country, are feeling the pain. The interest rates are too high for small businesses, and it's feeding into the concentration of wealth at the top.
David, I just want to understand that. Just give me some more color. How are you thinking about the Federal Reserve? Are you saying they need newer tools, more tools, or are you saying the emphasis should be elsewhere in Congress?
They have lots of tools. They have regulatory tools that really affect how lending is done within the country. They're not doing it in order to help small businesses. They need to be thinking about that. Also, the trade-off between the balance sheet and the interest rates, I think, can be done in a more effective way. They don't need to be owning all the bonds of the U.S. government. They're helping, you know, how is it that we're in this environment where central banks buy the bonds of their governments, and that enables big government spending? So you can change that in a way that's very pro-growth. And I think that also plays into making the dollar the reserve currency of the world. China is looking at it saying it sure looks to us like the United States has lost its way. It's chasing its tail. And that can be fixed, I think, pretty quickly by communicating clearly that you want a strong, independent Fed that is talking about the actual needs of the country as a way to bring down inflation and bring down interest rates.
David, you just sounded like you were saying that you think they should accelerate the balance sheet roll-off and get out of the Treasury business. And I'm trying to sort of match match that up with the prospect of extending the tax cuts of 2017. How do you do both those things at the same time? You know financial markets better than most. What was that going to look like?
They all go together, and they actually work toward growth. I think if they would shrink the balance sheet, remember the balance sheet has two sides, assets and liabilities. The liabilities that the Fed is using to hold all those bonds is short-term liabilities. They have this giant leverage to trade on that's lost a huge amount of money, maybe $1 trillion of losses from that trade. They can let it run off in a way that puts money through the private sector, so it actually gets to small businesses. Think how better the environment would be if we had lower short-term interest rates, and that I think can be achieved by talking about growth, about the dollar, defending the dollar, and about having more investment in the U.S. You'd have more confidence in the country and in the future, and that really was the theme at the convention yesterday.
You clearly have a very clear policy preference. David, I just wondered, do you have a clear preference on who you would like to run the Federal Reserve?
Oh, no, that's not so much the issue as the policies. We need good people in strong positions in order to turn the country around. I've written a lot about the need for a full upheaval of policy thinking, and especially the models at the Fed. You know, they're still basically operating under the Phillips curve model that in some way you have to have unemployment in order to bring inflation down. And I think that can be switched around to say, look, if we have more people working, you're going to get lower prices and lower interest rates.
One of the bad things about TV, David, is you run out of time. And this is one of those conversations where I needed an extra 30 minutes to get more clarity from you. David, let's do it again soon. Thanks for making time for us. David Malpass there, the former World Bank president. And some of the changes, Danny, we might be seeing.
Yeah, I'm really interested about that balance sheet comment.
Right?
I did think a little bit more about that one, I'm going to be honest.
Got to try and get some more clarity on the push here. The extra tools they could use,
right.
The extra things they could be doing,
right.
How that sort of is compatible with the stronger dollar at the same time.
And how it ultimately helps small businesses. Again,
yeah.
The wheels are turning.
There's a lot to discuss on all of these points. Coming up next, retail sales in America from New York. This is Bloomberg.
your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Counting you down to retail sales in America with the scores like this on the S&P 500. Equity futures shaping up as follows. Firmer by 0.1% on the NASDAQ, up by 0.25%. The outperformance on the Russell. Once again, the small caps up by almost 1%. In the bond market, 2-year, 10-year, 30-year looking a little something like this. The 10-year down by 6 basis points. Down 6 to 4.16. We're down 5. On a 30-year to about 4.40.24. With your retail sales numbers, let's get across to Mike McKee. Good morning, Mike.
Good morning. A little bit better performance for the American consumer than anticipated, though not great. Retail sales come in flat for the month of June, after being up 0.1%. But the forecast was for a 0.3 drop, so there's some good news there. Ex-autos is 0.4 gain, and when you look at the retail control group, it was up 0.9%. I want to check when I get a chance in a second to see what happened with autos, because remember there was that power out or computer outage for a lot of the auto dealers, and so auto sales suffered in the month, and that might be one reason we were only flat. Import prices come in flat. Ex-petroleum up 0.2 on a year-over-year basis now. Import prices are up 1.6%. That's going in the opposite direction of what we anticipated. But overall, John, it looks like a relatively good retail sales report. I'll check the details now.
And Mike McKee, that control group is 0.9. That's a big upside surprise. The survey, the estimate in our survey was 0.2. You put that together with jobless claims from last week, which was better than expected. You start to build the impression that maybe just that shaky period in the economic data was a bit of a head fake. We'll see. But ultimately, it's 2 data points that support the idea this economy, the consumer, is holding up okay. In the equity market, in response to that, let's go through the boards and start with equities and look at equity futures. On the S&P 500, we're firmer by 0.2%. We had some more weight to the small caps rally, up by 1.1%. In the bond market, the 2-year, 10-year, 30-year, we had yields down by 4 to 5 basis points, down about 5 or 6 at the longer end through much of this morning. On a 10-year, we're now down by about 4 to 4.19. So we give some of that up. If you turn to foreign exchange, the euro against the dollar, euro-dollar looks like this. Completely unchanged at 108.93. Mike McKee, let's get into that just a little bit more. The totality of the data, the Fed's favorite phrase. Do you think that shaky period for the consumer was a head fake, or do you think the jury's still out?
I think the jury is still out. The question has been, will the rise we're seeing in salaries, wages and salaries make up the difference from the disappearance of people's pandemic savings? And so far, it appears to be doing that. When you look under the hood here, we had a negative 2.3% drop in autos and other motor vehicle parts, but they fell 2.7% the prior month, so it's or a year ago. So it's partly seasonal here, but everything else, for the most part, is up except gasoline, and you'd expect that. Gasoline prices have been going down. That was down 3%. So you take that out, sporting goods and hobby stores down 0.1%. Everything else was up, including non-store retailers, 1.9%. Remember, they had fallen in the previous month, and people were questioning why that is. What should be interesting this month is, of course, we're right in the middle of Prime Days, and that tends to drive retail sales at non-store retailers a little bit higher.
Well, on the topic of goods and sales there, Mike, we've been seeing in the data this disinflation, or at least deceleration that was coming into the fore. Is there any sign of that in these numbers?
Well, these numbers are not adjusted for inflation, so you can take away the inflation numbers from it, and the numbers come in still very good because inflation was low, and these numbers were high, especially when you look at the 9/10 gain in the core group. If you have to seasonally adjust by category, or I mean, inflation adjust by category, so I can't do it off the top of my head, but it does show there's still strength in there even without inflation.
Mike McKee, thank you, sir. On the latest, this is a strong data point in America for retail sales. It's what we call an upside surprise. To break it down, Greg Dacko of EY alongside Andrew Husby of BNP Paribas. Greg, I want to come across to you first, sir. Your reaction to this data. Is the shaky period for the consumer over, or is the jury still out?
What we're seeing is just generally more prudence. I don't think we're seeing any form of retrenchment in consumer spending activity in this type of June report, which was quite strong across the board, as Mike was just highlighting, is indication that consumers are not pulling back, but they are being more judicious with how they spend, how much they spend, and where they spend. And that's still the reality today, despite this fairly favorable report. Let's not forget, you still have a jobs market that's still adding a decent number of jobs, 180,000 on a 3-month moving average, and wage growth is still around 4%. So combine the two, you still have that income support. It's not any sign of a retrenchment, but it is more prudence on the part of consumers.
The Federal Reserve for a while has pointed to the consumer, the labor market, and said the strength there is a reason to wait. It gives us the luxury of time just to see how the inflation trajectory changes, evolves. Greg, do you think they have that time? Can they wait? Can they skip July and wait until September?
I think we're not talking about necessarily bringing rates down to zero or cutting rates in an emergency fashion. What we're talking about is really recalibrating monetary policy. And I think now would be optimal to recalibrate monetary policy now that the labor market is rebalanced. You probably don't need as restrictive monetary policy now that the labor market is rebalanced and now that inflation is continuing to move to the downside. What you want to do is sustain the economic expansion in a low inflation environment that calls for a recalibration of monetary policy. I've been discussing this for a few months now. I think now would be optimal to recalibrate monetary policy. June would probably also have been good as well.
Andrew, let me bring you into the conversation, get your first read, and whether you kind of agree with Greg here, whether still now is the time to act.
Yeah, I definitely agree with Greg here. This is a consumer that's taking a breather after a pretty solid sprint over much of the pandemic here. So what we've seen in the consumer sentiment data is some fatigue about high interest rates and higher prices, but this is not, as Greg said, a consumer that's kind of rolling over, and the labor market is a key part of that. Income is still growing, wages are still growing, and really the economy is not really set to really take a dive right now.
The balance of risk around the dual mandate has clearly shifted, and you can see that with the communication coming from Chairman Powell. The focus now, can we say, is equally on CPI, it's equally on price stability and full employment?
I think if they're not going to say that exactly, basically that's where we are right now. It's a Fed that's going to be very attuned to weakness in the labor market, the jobless rate above 4.1%, the economy probably slowing below trend in the back half of this year on our estimates. So it's a time where they can think about recalibrating policy lower here.
Greg, with all the things of lining up to be able to recalibrate, Jan Hatzius probably agrees with you, and he even goes so far as to put a note out yesterday saying, why wait? If everything is lining up, why wait 7 weeks? Would you agree with that July actually makes sense?
I think June might have made sense. I mean, you're really talking about recalibrating monetary policy gradually. You want to avoid a situation where you're reacting to a more significant slowdown in economic activity. That's really the risk right now. As John was saying, you have an equally balanced environment when it comes to the downside risk on the labor market front and the easing of inflation. So now is really the time to gradually recalibrate monetary policy, do so with a lot of regard towards how the data is evolving, but gradually move towards a state where interest rates are more in line with potential growth for the economy and an environment where inflation is continuing to move towards 2%. So yes, I would agree with Jan Hatzius there in terms of easing monetary policy now and not necessarily waiting until September.
Andrew Honhorst of Citi yesterday put out a piece and the title read like this: rate cuts go from if to when to how many. On the if, not a matter of if. I think we're all waiting for that move. On the when, debate about whether it's July, September, or shortly afterwards. I think we can park that. Let's talk about the how many. Greg, when you start to adjust, are they talking about a fine-tuning, a mid-cycle adjustment? What kind of adjustments are you actually looking for? And how on earth, and this is the difficult question, can we make that call for 2025, given the kind of political conversations we're having in this country?
We tend to focus a little bit too much on the years, right? There's nothing that says that there have to be a certain number of rate cuts in any given year. We're anticipating a couple of rate cuts this year in September and December, given what we've heard from policymakers. And we're anticipating about 125 basis points of further easing in 2025. But as you said, there's a lot of uncertainty, whether it's political uncertainty, policy uncertainty, geopolitical uncertainty, that comes on top of the macro uncertainty. So the direction of travel of the economy is one in which you're seeing a gradual slowdown in the pace of growth, which warrants a recalibration of monetary policy. We're in the early stages now, and I think the Fed would be well placed now to gradually recalibrate and allow itself some time to observe how the economy is evolving while recalibrating the pace of monetary policy tightening.
The only thing certain right now is the uncertainty. But if we could pick up, Andrew, on the politics, how are you thinking about 2025? Because the Fed could be looking at a set of policies that are very different.
Yeah, it's certainly a key catalyst, obviously. Here we're talking about tariffs, taxes, other issues related to potentially labor supply as well. The key catalyst for us, we think, on the inflation front, the Fed might be thinking about or might have to think about in short order is tariffs. We did put out a pretty extensive note last month, and certainly there's a lot of detail that's left unsaid right now about what that might exactly look like. But illustratively, you're looking at inflation that could be a percentage point, couple of percentage points, or even several percentage points higher than the base case right now. So that, with the Fed having gotten inflation roughly in the neighborhood of where it wants to, it hasn't gotten it all the way home yet. So that's going to be potentially something that's going to be key.
Does that mean a hike potentially in 2025?
So that'll be, so with cuts priced in right now, one way you could look at it is basically just a hold for longer. But certainly, depending on the mix of policies, you could be thinking about hikes potentially after some cuts. So that you've seen in the past.
Andrew Husby of BNP Paribas together with Greg Deco of EY, both trying to figure out the future here, which is tremendously difficult to do in 2025. We could see some big changes. Danny, big changes to trade, big changes to the Federal Reserve. I just want to reflect on the conversation we had with David Malpass, the former World Bank president, who was talking about maybe shifting the emphasis of the Fed's balance sheet away from supporting the Treasury and towards supporting small business. These are some big ideas.
One of the things that I kind of struggle with that is it is more than just supporting the Treasury. Part of their balance sheet and part of why you've seen them even slow their runoff is to avoid financial shocks. That is a big factor of this. So if you say, okay, we need to completely run this thing down, I mean, what happens when we enter a COVID period where there are issues of liquidity in the system and the Fed doesn't have that base? I think if you take that out, sure, you maybe can make Malpass's argument, but I mean, it's kind of an elephant in the room.
What happens if you have the administration come out and talk about the extension of the tax cuts as they are already, and that collides with the Federal Reserve that wants to aggressively roll off the balance sheet away from treasuries even more? This is really complex stuff and tremendously difficult to work out what's going to happen. What Fed policy looks like in all of that, I've got no idea.
And I mean, will it even be Powell? He says he wants to stay until 2026. That's a big question of it, too. By the way, did you hear Powell talking about dinner and how he doesn't go out to dinner anymore? With David Rubenstein,
I missed that.
He told David Rubenstein that he doesn't go out to dinner in public anymore because people listen to his conversation. He only eats at home and over at friends' houses.
That sounds really sad, doesn't it?
It does sound sad. I mean,
okay.
I would be one of those
but
people.
But why is he worried about his conversations being heard?
That's a good point.
Does he talk about policy out for dinner?
That's a very good point.
If he does, John's going to start stalking him.
I tried to do that at Jackson Hole once. Tried to listen to some of the conversations.
What was he eating?
Yeah, it wasn't Chairman Powell, someone else. Okay, let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Retail sales for June delivering an upside surprise, coming in unchanged after economists had expected a drop of 0.3%. The Retail Sales Control Group, which excludes food services, auto dealers, building materials, and gas stations, rose 0.9%. Well above the median projection of 0.2%. Investors now looking ahead to a slew of Fed speak this week for clues on the central bank's path forward. Elon Musk is throwing his weight behind Donald Trump, pledging to pour $45 million a month into a pro-Trump super PAC. This coming after Musk's public endorsement of Trump over the weekend. The billionaire's cash infusion likely to help build Trump's fundraising over President Joe Biden, who is now suffering from a donor revolt over calls for him to drop his candidacy. Other donors to the America PAC include crypto billionaires Cameron and Tyler Winklevoss. And Donald Trump, the presumptive GOP nominee, announcing Ohio Senator J.D. Vance as his running mate on the first day of the Republican National Convention. The pick signals what's likely to be a pro-tariff ticket. Trump earlier this year reportedly said he was considering a flat 60% tariff on Chinese imports, and Vance, in one of his first interviews since being named Trump's running mate, called China the biggest threat to America. That should be our brief. John?
Yara, thank you. Up next on the program, we'll set you up for the day ahead and we'll catch up with David Rubenstein. All of that just around the corner. From New York, this is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg.
Counting it down to the opening bell, equity futures here positive by 0.25%. Bond yields a little bit lower. We're down by 2 basis points now, 420.80. Just a moment ago, had a really nice retail sales print. Upside surprise on retail sales in America. Here's the trading diary for the day ahead in the next few days. Nikki Haley will speak at the RNC a little bit later on. Wednesday, we'll get the Fed's beige book, and Trump's VP pick, J.D. Vance, will take the stage in Milwaukee, Wisconsin. Thursday brings another round of jobless claims and Netflix earnings after the closing bout. Plus, Trump delivers his nomination speech that evening. A programming note for you. Joining us right now is David Rubenstein of the Carlyle Group and host of Bloomberg Wealth. His latest interview is with Philippe Lafont of Coatue Management. He is the founder of that company. You can watch it on Bloomberg TV at 9 p.m. Eastern Time. David, wonderful to catch up with you, sir. We've got tons to talk about this conversation. We've got to talk about your conversation with Chairman Powell as well, and the VP pick too. Can we just start with Philippe Lafont? What do we need to know about this gentleman, and what can we look forward to later this evening?
Philippe Lafont is an immigrant from France who came here at the age of 16. He worked for Julian Robertson after he got his degree from MIT, and he built one of the largest hedge funds in the technology space. It's about a $50 billion hedge fund, and he's had successes through up and down times in the economy, and I think he's considered one of the best technology investors in the country, and he's built a really wonderful reputation for investing in technology companies in the United States and around the world.
David, while we have you, we have to talk about your conversation with Powell. You tried very much so to get something out of him in terms of when he might move. Some even chuckles in the audience as you did that, but he stayed very steadfast. What was your takeaway from that interaction?
Well, he's very experienced at not saying anything that will get him in trouble. Obviously, he's not going to make any comments unless they're official comments, and he wouldn't make those until after there's been an FOMC meeting. So I think he's very polite, he's very smart, he's worked with me over the years at Carlyle, but he doesn't tell me anything that he shouldn't tell someone like me, so I couldn't get him to say anything other than that he'll have an FOMC meeting and they'll look at the data and they'll do what the data suggests. So that's all I know. I don't know any more than I knew before, I guess, really. But I'm glad he did the interview and he gave some insights into what it's like to be the Fed chairman, because obviously everybody's paying attention to every word you say.
And David, you caught up with him a few times, though, in a post-pandemic world. The inflationary challenge in front of him at the time, how difficult it was. It just feels like that's slipping into the background, and the focus is shifting a little bit more to the labor market. Can you give us your impression of how the arc of your conversations has shifted somewhat over the last few years with him?
Clearly, when inflation came, it was not recognized as being as enduring as it turned out to be. The Fed chairman and the Secretary of Treasury and others said it was transitory. They recognized later it was more enduring than that. But I think the Fed did a really good job of increasing interest rates without putting us into a recession. As you may recall, people were predicting that the high interest rates would produce a so-called hard landing last year and a hard landing this year, and it hasn't happened. And so now we're at the point where interest rates are likely to be lowered, and we haven't had the hard landing that people predicted. So I think the Fed deserves, along with others, some credit for managing this high inflation period of time.
David, I'd love to get your thoughts and reaction to what we found out last night, which is the VP pick for Donald Trump. It's going to be J.D. Vance, really emblematic of this pivot of the Republican Party to the populist wing. Who do you think represents the pro-business interests in America now?
Well, I was somewhat surprised by the selection only because, he's young. He's 39 years old. We've had young vice presidents before. But I thought, he added less to the ticket than some of the others. But obviously, Donald Trump, knows what he's doing in terms of politics. He seems to be, pretty successful in that area. I would say I knew J.D. Vance before he got involved in politics. He was working for Steve Case at a startup kind of venture fund to invest in companies throughout the United States, but not just in Silicon Valley or New York or Boston. And that, called Rise of the Rest, was a fund that J.D. Vance was working at, and I invested in the fund. But before the fund was completed, he left and did something else. So I met him in that context. That was before he was involved in politics.
David, did you invest in the fund because you also were interested in the individual?
No, it was Steve Case who had the track record of and the concept of investing in technology companies that are not just in Silicon Valley or Austin or Boston. And so it was investing throughout the Rust Belt, among other places. The idea was that there are good technology companies there as well. And so that was the idea. And because I guess J.D. Vance had been from the Midwest, he was thought to be a pretty good guy to invest in that kind of company. And so he did that for a while. I think he left after maybe a year or so to do something else in Silicon Valley.
David, what do you think the business environment needs to expect now, given the potential of a second term with Donald Trump, and some of the thoughts that we've heard already from Senator J.D. Vance on things like antitrust, on regulation of technology, on mergers and acquisitions? What do you think's in store? And is the Republican Party of old? How much has it changed over the last few years? Is it still that traditional pro-business movement?
Well, obviously, the Republican Party of the 1950s, 60s, and 70s is not the Republican Party of today. It's different. I think trying to predict what the party is going to do and what Donald Trump is going to do if he's elected president is very difficult at this point because he hasn't picked all of his advisors. But it's clear that Donald Trump controls the Republican Party, and it's pretty clear that he's got a very good, healthy position today as he goes forward. I was sad to see, obviously, that the shot at him over the weekend. We're very fortunate that he was not more severely injured because, as we all know, a half an inch either way, it would have been a very tragic accident for the country and for his family. Fortunately, that didn't happen.
Absolutely horrific. But David, you did not answer my question originally, so if I could just get back to that. Which party is now the pro-business party?
Well, both parties have certain pro-business elements, and business people will complain about both parties on certain areas. So I don't think it's fair to say either party is the pro-business party because business is so many different types of business. But clearly, the Republican Party today is different than the Republican Party of 20 or 30 years ago or when I worked in the White House more than 40 years ago. And clearly, the Democratic Party is different than the Democratic Party of 30 or 40 years ago. So the world's changed, not surprisingly. I think both parties offer some things for the business community and some things the business community doesn't like. But I think it's too early to say what President Trump would do if he were elected. and it's too early to say what President Biden would do if he were reelected. It's just too early because we're just too far away from dealing with the economic situations that we'll see in next year.
Well said. David, it's fantastic to catch up with you, sir. David Rubenstein there of the Carlyle Group. You can watch David's interview with Philippe Lafont a little bit later at 9 p.m. Eastern Time on Bloomberg TV. This has been a theme for this program over the last 3 hours or so, the difference between campaigning and what you can expect when they start governing. And to David's point, it's tremendously difficult to work out what it will look like when they start governing, if they start governing.
Absolutely. We're hearing a lot of rhetoric. We need to see what that would transform and that would mean for policy. I will say, though, the pick of J.D. Vance, for those within the Republican Party that thought potentially they were going to go back to traditional conservatism, traditional pro-business. That is not the pick. This is a pivot to the populist right, which is why it's going to be so interesting tonight when we hear from Ambassador Nikki Haley, especially when it comes to foreign policy. She still wants more funding and support for Ukraine. There's a lot of circulation happening of what J.D. Vance has said in the past about Ukraine, at one point saying, I don't really care what happens to it either way. They're very different tenors of the Republican Party.
It's true, but again, where there is something united, it's on China, and at least for J.D. Vance and Trump, it is the dollar. Again, when we're saying how much is J.D. Vance going to be able to influence Trump, on some of these things you can say, okay, the pick of J.D. Vance was about campaigning, but some of these things, it's about governing. They are so closely aligned. I don't know about the antitrust element. I don't know how much Trump is going to sign on to that. But again, there are things that are very strong. They're both in it together.
This pick inks Donald Trump as the populist wing. His wing of the party is now taking control of the GOP. And I think that this pick really solidifies that. But also, J.D. Vance is going to help him in the states Biden needs the most. The one issue that's going to come up is the individuals in those energy districts in Pennsylvania are already going to vote for J.D. Vance. It's the women in those districts. Who do they go to?
For the markets, could it be the small caps presidency? Counting you down to the opening bell, 35 minutes away. Equity futures on the S&P up by 0.2%. The small caps is where the outperformance is this morning. Yields a little bit earlier. We're down by about 5 basis points at the long end. Given the retail sales number we got 25 minutes ago, we undo some of that. It unwinds. We're down by about 2 basis points on a 10-year at 420.99. And the dollar comes back a little bit stronger with that move. Euro dollar 108.78. Tomorrow, here's the lineup for you. Brian Nick of New Edge will catch up with Tobin Marcus of Wolfe Research and a man who was in the running to become the VP, Virginia Governor Glenn Youngkin, sitting down with Anne-Marie at the RNC. We'll catch up with Mike Schumacher as well of Wells Fargo on this bond market. Much more still to come from New York City this morning. Good morning to you all. This was Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons. a year in terms of what we have to replace.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. We do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Markets continue to climb higher in the week of the RNC. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Kicking you off with U.S. retail sales, excluding autos, rose in June by the most in 3 months, suggesting consumer resilient spending at the end of the second quarter.
And earnings season ramps up with financials firmly in focus. Bank America trading tops while Morgan Stanley's wealth unit lags.
And Silicon Valley cheers Trump's VP pick. The former president taps Ohio Senator and ex-venture capitalist J.D. Vance as his running mates. Let's take a look at where markets are trading right now. And we're looking at a rally, of course, after retail sales, as Shonali mentioned, stronger than expected, flat, but not a decline. The S&P 500 up about 0.2% in the pre-market. Same, too, if you take a look at big tech. Meanwhile, the Treasury market, you can see yields actually down a little bit right now, about 2 basis points, but that 10-year camped out at about 4.2%, Matt.
All right, taking a look at what's happening in terms of retail sales. Here you can see the BN survey was for a drop, but we actually had a beat there. So better news for the consumer. What does that say about the Fed?
I'm also keeping an eye, of course, on those bank shares, watching Bank of America beating on trading and net interest income, up about 0.8% pre-market, but Morgan Stanley missing on wealth management revenue, bringing it down almost 3.6% pre-market. Schwab also dropping more than 7% pre-market after reporting that fewer clients opened brokerage accounts than expected, Matt.
All right, we are getting breaking news. The IMF just releasing its World Economic Outlook, warning about the risk to global growth from interest rates staying higher for even longer. If you take a look at the actual headlines here, you can see that the IMF expects global GDP growth in 2024, this year, to be unchanged at 3.2%. It raises 2025 world GDP growth estimate from 3.2% to 3.3%. So little changes there, but the real warning is that the slowing disinflation risks really among higher rates.
Yeah, it's interesting, of course. This comes as we've heard from Chairman Powell just yesterday saying that this recent data that we've gotten on inflation, on the economy, it adds somewhat to his confidence that the Fed is going to be able to embark on a rate-cutting cycle sooner rather than later. But still, to get this IMF warning, the timing is very interesting here.
And certainly against the bond market, you are seeing that bid across the curve today after those retail sales. We have the ECB just days away as well. Let's see if we can get rates lower across the world as fast as traders
I do feel like my share's a little bit high here. You know what?
Maybe you're just a lot taller than Matthew Miller.
To your level there. I don't know what was going on.
I feel shunted today.
Let's get out to Mike McKee right now, our chief economics and policy correspondent. He's got a deeper look into the IMF and retail sales, really. Mike?
Well, Matt, retail sales were better than expected, even though they come in flat for the month. As you mentioned, there was an expectation of a 0.3 decline for the month. But the real problem was, as economists thought, automobiles, because the outage in the computer systems for many auto dealers in June hampered sales. And so we saw auto sales down on the month by 2%. And that is the biggest mover that subtracted from real growth. But auto sales don't go into the core, as does gasoline and building materials. And so core was up a strong 0.9%. That's really good news overall for the economy. It shows consumers maybe taking a little breather, but they are not falling off the edge. And so the Fed can, if they want to, at least in private, talk about a soft landing. We also saw strengths in department stores, and non-store retailers were up 1.9%. Now that we're in the middle of Prime Days, we'll probably see that number go up for the month of July. So all in all, good news. The import price index also flat on the month. So inflation showing some signs definitely of slowing down. And that's important because the retail sales numbers are not adjusted for inflation. And they had gotten a boost not only from the pandemic payments people got, but from inflation, because they're measured in dollar values. But what we see here is that inflation has come down and retail sales are holding up even without that boost from inflation, and that has to cheer the Fed. You look at what the markets are thinking right now, and basically they've repriced in September as a rate cut. Remember yesterday, after Jay Powell, they took it out. It's back now and probably going to stay given the way the economic data are going.
All right, Mike, thanks very much. Michael McKee there talking to us about retail sales. Joining us now is Cameron Dawson, Chief Investment Officer at New Edge Wealth. Cameron, it's interesting, as Shanali points out, the timing of the IMF warning on inflation. It doesn't really help Jay Powell if he wants to cut rates sooner than later.
Yeah, and I think it's really also interesting in the context of Bank of America's earnings this morning. They talked about how some of these loans that were done in 2020 and 21 are now starting to reprice higher at higher levels. So this idea that higher for longer is finally going to have an impact on the economy and weigh on economic activity. And we think that that is something to watch as we go into 2025.
But let's talk about the U.S., because I hear what you're saying when it comes to that higher for longer. But you take a look at today's data and, of course, the market reaction. Retail sales, they were flat, but better than expected. It feels like it's sort of this best of both worlds, where that's not going to shift the odds of September, but it's not like the consumer is really deteriorating.
Yeah, true Goldilocks. We can have it all, meaning that you can have this deceleration in inflation. It's not showing up in higher prices, even though we are getting higher demand. And this idea that we still have an underlying strength and resilience of the U.S. economy. It does not mean that there aren't signs of fraying. You also heard that from the banks, that there is a bifurcated consumer, but that bifurcated consumer isn't pulling down the aggregate data yet.
When you look at WIRP Go on the terminal, this is the world interest rate probabilities, you see traders starting to bake in not only a sure thing for September, but closer to 3 cuts this year now. And when you think about what you were saying about that lagged effect, about banks just now passing on those higher interest rates at a greater rate to consumers, do you think we need those 3 rate cuts, or do you think it's even achievable?
It's a really good question, because if we do 3 rate cuts, does that signal urgency by the Fed? If they're cutting every single meeting, is that because they have to? Does it mean that they're seeing something that we're not seeing? I think that the data today, retail sales holding up, even though inflation's coming down, it warrants letting them have patience, because it just leaves the door open for them to do what they want to do in 2025 versus having to continue with this every single meeting cadence.
Will they be able to cut in 2025 if Donald Trump is elected and we get 60% tariffs on Chinese goods across the board? I mean, everyone has come out and said that would be very inflationary.
Talk about a wild card. The thing about the inflationary dynamic of tariffs is we have to offset it by the fact that it typically weighs on demand. So meaning tariffs kind of act like a tax. You see demand turn lower. If you look at the inflation data from 2017 through 2019, when tariffs were being enacted in his last presidency, what you saw is that durable goods inflation did turn higher, but it was all offset by falling gasoline prices and the fact that non-durable goods inflation turn lower. So I agree that that would be the big wild card. If you slap big tariffs on goods, could we see that durable goods prices start to really move higher?
How do you handle a wild card? Is that something that you hedge for? And if so, do you hedge for it now, or what does the timing possibly
also,
look
how
like?
wild is it? I mean, it's starting to look like not very wild at all, right?
Yeah, meaning that it could start to get priced in. And maybe the observation is that it's getting priced in more in international markets at this point than maybe in U.S. markets. And I think it's a question of how much can companies pass through increased input costs into consumers. One of the interesting things that we've been seeing is that a lot of input costs still are going up. Things like shipping costs are skyrocketing, but durable goods prices aren't moving. This tells you that companies are losing pricing power. And so in a world where consumers really are getting stretched, how much more increase in prices can they take?
Cameron, I'm going to resist the temptation to talk about the topic du jour and bank earnings season and earnings season more generally, because we're going to get very quickly into tech earnings. And you have the overlay of the election cycle and Trump picking a running mate here in a person who demanded a breakup of Google at one point. So how much risk is there to big tech heading into next year?
I think that the thing that keeps tech continuing to be propelling is these semi-monopolies, this incredible earnings power, incredible return on invested capital. There have been pockets of times where there have been threats to that, but they've been so de minimis compared to their incredible earnings power that you simply haven't seen tech price in the question of could you see that earnings power get dented in the future. Maybe that's something that we start to see reflected in multiples. It remains to be seen if markets will want to price that in early if you're seeing no signs of regulation. But of course, that is, again, another wild card.
How do you deal with all of this political risk? I mean, we were talking about J.D. Vance this morning, and of course he has been against social media, the censorship of conservative views. He's called for the breakup of Google, again, recently. This isn't something that he said only in the past. And now he's going to take, or the Trump PAC is going to take $45 million a month from Elon Musk. So, it goes both ways, and I guess you have to really be deep in it.
I think that there's 2 points. The first one is that markets do what they do in spite of or despite of what goes on in Washington. So if you look at the markets in aggregate, it pretty much is equal whether or not you get Republican or Democratic control. The other one is that markets tend to price in a lot prior to an election and don't necessarily follow through after it. Look at the industrials in 2016. You priced in this huge infrastructure, all these changes in spending, and they peaked on a relative basis 2 weeks after the 2016 election and have still never made a new relative high. So that's where we might price in a lot prior to the election, but it could be a buy the rumor, sell the news kind of situation.
And I'm going to ask you about something other than politics, because we have to talk about what's going on with small caps and this rotation trade that we're seeing. The Russell 2000 index up by more than 1%, 4 days in a row. It's been quite a while since we've seen that. Is this sustainable? Do we actually have the corporate earnings power to back this up?
That is the ultimate question. We think it's sustainable for at least the next month or two. Positioning is so very light. You saw a lot of ETF outflows that there's a snapback trade just because of that. But then it comes down to earnings, and earnings will be the driver as to whether or not this is a 2-month or a 2-year trade. Look at earnings expectations for small caps into 2025. They have earnings going from 3% this year to 36% next year. Wow. That means small caps have to deliver. And if they don't, you go into an earnings revision down cycle. The key reason why small caps have underperformed over the last 2 years is because earnings have been revised down by 25%. So if you're bullish, you say earnings growth is going to get a lot better for small caps, we can buy them. If you're bearish, you say that's a high bar. So our mantra right now is we're here for a good time, not for a long time. We'll buy small caps, get this chase rally, then we'll keep reassessing the EPS trajectory.
Cameron, we thank you so much for joining us. That is Cameron Dawson of New Edge Wealth. We're going to take a quick check now on some of the other companies, finance companies, reporting this morning. Of course, we're taking a look at PNC Financial, guiding net interest income growth of -4% this year, and Schwab down more than 7.8% after new brokerage accounts missed estimates. State Street still, though, on the rise. Recapping a few things also from Bank of America, which is well underway with their earnings. Remember, they increased their net interest income guidance here, and interestingly enough, they say that the benefit benefit will be smaller sequentially in the first quarter of 2025 for that net interest income benefit. It'll start rolling up into 2026, Matt.
All right, we're going to talk more about bank earnings and maybe mix a little politics in there as well, because J.D. Vance does sit on the Senate Banking Committee and has partnered with Senator Elizabeth Warren in the past, which is, I think, absolutely fascinating. Stephen Bigger is going to join us, Argus Director of Financial Institutions Research. This is Bloomberg.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking? I mean, like, what's that about?
We're not forcing everybody to, be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier, right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
This is Bloomberg.
Now to high interest, to look at what's making headlines around the world. Donald Trump made his first public appearance since the assassination attempt. He appeared at the RNC in Milwaukee as Republicans gathered to nominate him as their presidential candidate for the third time. Trump stood next to his VP pick, J.D. Vance, a 39-year-old senator from the great state of Ohio. Vance named China as the biggest threat to the U.S. in an interview with Fox News. President Biden labeled J.D. Vance as a clone of Donald Trump. The president's remarks were just one part of a full-court press deployed by his campaign after Trump's selection was announced. Democrats seek to cast doubt on Vance's independence and populist credentials by painting the venture capitalist turned senator as both subservient to Trump and the elite. Elon Musk is pledging to pour $45 million a month into a pro-Trump political action group. The planned cash infusion could help build Trump's fundraising advantage over President Biden. Palantir's Joe Lonsdale and crypto billionaires Cameron and Tyler Winklevoss are among other prominent donors to the PAC. And after firing tens of thousands of workers, Tesla is steadily adding employees back again. The company is looking to hire nearly 800 new employees. The positions range from AI specialists to more run-of-the-mill service jobs. The pickup in hiring has coincided with Tesla shares going up on a tear. Sonali?
And more bank earnings out this morning. Bank of America said net interest income would climb by the end of the year. Meanwhile, Morgan Stanley's wealth management unit missed on analyst estimates here. Joining us now is Stephen Bigger, Director of Financial Institutions Research at Argus Research. And Stephen, you look at what had happened this morning, Morgan Stanley being among the most expensive of the pack from a price to book perspective here. How much room do they have to miss on a key metric like that?
Well, yeah, missing is never a good thing, obviously. The strength from capital markets is going to have to outweigh a lot of that and some of the deposit pressures that they talked about this morning in the release. So, yeah, I think it's, these banks broadly have an improving backdrop of capital markets after, 2 solid down years. Revenues now look pretty promising, and we're seeing these, big divergence, obviously, between the companies, 20 and 70% year-over-year gains in investment banking. So I think the improvement story should be looked at in the vein of the past 2 years and relatively weak comparisons, but still, clearly a much better backdrop for investment banking now.
How much of a tailwind could rate cuts start to provide some of these banks? You think about Bank of America finally guiding higher on net interest income through the end of the year, but also telling analysts now that the benefit will be smaller going into next year and taper off into 2026. How do you handicap that?
Well, at least it was good to see that the narrative has been unchanged since the guidance after the first quarter, that the second quarter would be the trough. So we didn't expect an enormous rebound. If you go back to the beginning of the year, most analysts had expected a deeper rate cuts this year. In fact, we would have already started, so we've not done that. And therefore, banks are still facing some pressure from higher deposit costs. Just not getting that net interest margin improvement, nor the loan growth, which has been very anemic, again, thanks to higher interest rates. So I think at this point, it's safe to say that the high rates have kind of overstayed their welcome. Banks would benefit from loan growth and take some of the deposit pressures off if they moved a little bit lower. Having said that, banks, of course, are very interest-sensitive vehicles, but they're also extremely well hedged. And they can survive a higher interest rate environment. The longer rates stay, high where they are, deposits will reprice, but so will the securities, which have been underwater. So it's kind of a double-edged sword for banks. But at this point, it does seem like lower rates would be much more beneficial now than where they're at today.
I also want to talk about Charles Schwab, which reported this morning. And you take a look at net income, that beat estimates. Earnings per share beat estimates as well. But the stock is down about 8% because you take a look at new brokerage accounts in the quarter, missing expectations. Again, a really dramatic reaction in the stock, if you want to call it that. You have a buy rating on those shares. What do you make of this morning's results?
Well, yeah, Schwab has typically grown their pace of accounts at a faster rate. So it is a bit worrisome. We'll be interested to hear what they say about that. One thing that we have been a bit concerned about past the integration is that a lot of the customers that had accounts with both Schwab and TD Ameritrade, or only with TD Ameritrade, would maybe move somewhere else. They had the opportunity to be with Schwab. Maybe they didn't want to go there, so they'll take their account elsewhere. So I think that could be some of what the weakness is there. But still a terrific franchise in terms of their margins. The deposits have stabilized from a year or so ago. Still a bit more expensive, but the outflows that we had been seeing last March have certainly subsided. So, we'll take a look at the more of the commentary that they have at this point, but I do think the future is still bright for Schwab.
Stephen, how would a red sweep look to you? How would it look to the big banks? Because as we've been talking about, J.D. Vance, the new VP pick for Trump, has partnered with Elizabeth Warren on bills to end or crack down on credit card swipe fees, legislation to end tax-free mergers and acquisitions. On the other hand, he's opposed, bigger capital requirements that the Biden administration would like. So what does it look like to you if Republicans take over?
Yes, well, that dynamic is certainly a strange bedfellows, I would say. A little not what you'd expect. I think the prevailing narrative with a Trump win would be that there would be a much easier regulatory environment, that M&A activity would have a much easier time of getting through the Justice Department, Federal Trade Commissions, et cetera. And this may throw it in a little bit of a monkey wrench to that narrative, I would say. But overall, I think Trump will be the more dominant voice here. there's probably things that the J.D. Vance could do in the administration that would kind of ease some of those concerns and some of the, the breakup talks of big tech and so forth might be watered down a bit. So I think the broad narrative remains in place that better for financials under a change in administration.
All right, Stephen, got to leave it there. Really appreciate your time this morning. Our thanks to Stephen Bigger of Argus. And later today, we'll be speaking with Bank of America CEO Brian Moynihan. That's at 2:30 p.m. New York time. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves on social media this morning. And first up, in case you haven't heard, it's Amazon Prime Day. It's estimated that U.S. shoppers will spend $14 billion online during the two-day sale. Prime Day is starting 5 days later than last year, so it's closer to the back-to-school shopping season. Now, competitors like Walmart and Target, they're also offering their own deals to try and lure shoppers. Next up, United Health beating second quarter earnings estimates, even as it reports higher than anticipated medical costs. The insurer is also trying to ease investors' concerns about higher costs in the aftermath of a February cyber attack on one of its subsidiaries. And finally, General Motors CEO Mary Barra is walking back expectations for the company's EV program. At an event yesterday, she said that GM won't have enough production capacity in place to meet the target of 1 million EVs at the end of 2025. One reason for the slowdown? Not enough demand. We've definitely heard that one before. And you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Now, coming up, we'll speak to Marianne Bartel. She is Chief Investment Strategist at Sanctuary Wealth, why she thinks small caps will continue to underperform. This is Bloomberg.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. Right now we're looking at futures that are pointing higher across the board. S&P futures up about 0.25%. Russell 2000 futures up almost 1% right now. On the New York Stock Exchange, we have BUD, B-U-D is the ticker, ringing the bell with members of Team USA, celebrating the coming Olympics. Simply Good on the NASDAQ, celebrating, I think, 7 years since the IPO. And then in terms of stocks, we continue to rise again. Will we hit a 38th all-time high today? Katie Greifeld?
All right, well, if you look at it right now, we're certainly on track to do that. The S&P 500 up 0.3% as those bells ring. The NASDAQ 100 too, but small caps obviously in focus right now. This would be a 5th straight day of gains, currently up about 0.9% on the Russell 2000. But one stock we're keeping an eye on in specifics is Match Group, climbing after Starboard Value became the 3rd activist investor this year to take a stake. You take a look at shares right now, currently up almost 6%, Janali.
Also, Katie, keeping an eye on those bank stocks heading into the open. Bank of America and Morgan Stanley moving in different directions. Bank of America up about 1.2% after beating on net interest income. Morgan Stanley missing on wealth management, down almost 2%. And remember, Schwab dropping the most, about 6.4%, 6.3% on the day, reporting that fewer clients opened brokerage accounts than expected.
All right, and the Trump trade losing steam on day 2, at least Trump media was. We had Palantir lower this morning, then it moved higher. Now it's lower in the cash trade. Let's get a closer look at Bloomberg's with Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, Matt, what goes up must come down. That is Newton's 3rd law, equal and opposite reaction. Well, in the case of the Trump trade, it is opposite today, but it's not equal. You were mentioning that we have the shares of DJT lower, down 9.7%. Palantir, it is actually equal, but of course, yesterday, all of these Trump-related stocks and sectors that could potentially do well from policy changes if he is elected in November, and of course, after the assassination attempt and his fearless reaction, that's how the markets were voting. Today, though, we do have a bit of a cooling for some of those stocks. The stocks more associated with President Biden, yesterday plunging, now today they're higher. What I would argue here, though, is we're seeing volatility. If we take a look at DJT, since it did start trading on the NASDAQ, we can see lots of big moves. Most of these moves, in fact, are are up more than 1% or down more than 1%. Today, we're looking at the biggest day since the company started traveling or trading. I'm traveling backwards, trading on the NASDAQ. Here you can see.
Doing the moonwalk, Abby.
I could do the moonwalk. Up 31% yesterday, today down. But take a look at the 20-day moving average. Katie, that's a smoothed out look, still above it. Let's keep watching this trade. I'm guessing we're going to have lots of movement ahead.
Absolutely. Abigail Doolittle, thank you so much. And sticking with politics, actually, we have some breaking news right now, and that is Andreessen Horowitz planned to donate to a Trump PAC. This is according to reporting from The Information that Andreessen Horowitz stepping up to donate to a Trump PAC. Of course, we've seen Wall Street and a bunch of billionaires come out in support of former President Donald Trump campaign. We'll bring you more details as we have them. But let's take this conversation to the markets and welcome in now Marianne Bartels. She is Sanctuary Wealth Chief Investment Strategist, and obviously politics is the topic du jour. So picking up on where Abigail left off, that you've seen a lot of the Trump trades kind of reverse from what we saw yesterday. When you think of some of the themes that have emerged in the run-up to that November election, are these investable themes or are these just trades?
Well, Katie, we actually started saying since the debate between Trump and Biden, the market has already started to price in a Trump win. And I think that trade continued with more momentum after the events of the attempted assassination of Trump. So are some of these investables? It depends on what pocket. You know, financials are running on Trump, but also running on lower interest rates. I like bigger banks, not necessarily a bigger fan of regionals. I'm still concerned about commercial real estate eventually hitting their balance sheets. Their balance sheets aren't as diversified as the bigger banks. You know, the market is looking for deregulation under Trump. But, you know, technology's been leading, and it's going to be a question as to whether or not Trump will continue to be a fan or not a fan. He's actually doesn't like big industry in tech, so there's some concern in tech. But in general, markets trade on earnings, and we're right in the middle of second quarter earnings. We're looking for strong earnings in the second quarter, actually even going into the end of the year. So we think that the market has momentum this summer. It's a seasonal rally. Do you think we can get a pullback in the fall, but then another year-end rally?
Yeah, I wonder about the potential for a rotation because our own Gina Martin-Adams at Bloomberg Intelligence has said that, you know, the S&P 493 are going to finally come out of this year-and-a-half-long earnings recession they've been in. Meanwhile, the Magnificent Seven, although earnings are going to grow there, aren't going to grow as much as they have been in the past few quarters. And as you mentioned, you know, under the Trump administration, the DOJ opened investigations and sued Facebook, Apple, Alphabet, you know, and a number of these other Amazon, big tech companies. So do you see a rotation that might not result in new all-time highs for the S&P?
I still think we can hit new all-time highs, but it's a very good point. We started getting a rotation in the market on the CPI numbers last week, and the market's starting to price in that the Fed will cut interest rates in September. And the rotation I'm actually seeing is some weakness now in tech. I think technology and the stocks that have profited very well this year are being used as a source of funds to rotate into cyclicals and to some of those 493 stocks that have not performed. We're also getting a very strong rally in small cap. I'm still very skeptical whether or not small cap will take leadership. I still think this is a mega cap cycle, but they are being powered higher because hedge funds were very short, and I do think we're getting short covering, and that's not completed yet. So on a tactical basis, I do think small cap do run. What I'd be paying attention to call a correction in this market are semiconductors. They've been the leaders of this whole market. They're starting to look tired. If you look at the technicals, they have not been able to break out to a new high. And if they don't, that's going to be a warning sign. And the same is true of the leader stock, NVIDIA. So I'd really be watching those as early signals as to whether or not this market can correct in the fall.
You know, it's interesting, even beyond the fall, you think about the risks, not just valuation risks, but any political, geopolitical risks as well, Marianne. I think back to J.D. Vance in one of his first interviews overnight here with Fox News, this idea of China being the biggest threat. What does that mean into a potential Trump administration for the semiconductor industry?
Well, certainly Trump is not a fan of China. He would be expected to lay on a number of tariffs. In the region, though, India should benefit. That would be a beneficiary if he really goes after China. In terms of technology, semiconductors, you can't have AI without semiconductor chips. And I do believe that politicians will understand this and will allow semiconductors companies to blossom, because without them, we don't have AI.
And so, interesting point there. You think about just sort of the geopolitical importance of semiconductors. Maybe they'll escape through some of that focus that we've seen on tech. But when it comes to the AI theme, of course, like you said, we can't have AI without semiconductors. But if you follow that down, sort of to the downstream, where else can you follow that AI investable narrative to?
You know, you can even find them in utilities because the power demand, not just from AI, but for EV cars, for the blockchain. But some of the companies that have been in utilities that have been trading like growth stocks look like they could become a little bit toppy. That's like a Vistra or a Constellation. You know, software, parts of the software market have been a little bit weaker, trying to figure out how companies are going to spend money on AI. But what I learned very early in my career is that there's a cycle to technology, and it leads with semiconductors. You upgrade with hardware, and some new old names that you're now hearing in that hardware space are Dell and Hewlett-Packard, and then that also leads to software. So no matter what administration wins this election, I do believe in AI. I do believe companies will continue to grow and benefit and have earnings, maybe not at the same pace, but I do believe tech will remain the leadership of this market.
Our thanks to Marianne Bartels of Sanctuary Wealth. Thank you for joining us on, of course, a very complicated environment out there between the Fed rate outlook as well as the politics in the United States. I do want to bring you some headlines now from Morgan Stanley's analyst call currently underway. CEO Ted Pick, of course, his first year in the job, saying the bank is navigating geopolitics, the rate cycle, and the U.S. election. He says those are some of the key themes facing the sector down the road. He also says we're back in institutional equities, so playing up their historical strength there. Of course, as we know, stock is under pressure just a bit here as they missed on those wealth management revenues. But earlier, the CFO telling Bloomberg Sridhar Natarajan that 17% returns on equity are nothing to cry about, guys. Coming up, the analyst action that you need to know this morning. That's up next in our top calls. Stick with us. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see
see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. Quick check on where stocks are 14 minutes into the session. We are up, but not yet in a 38th record high. 56.50 the level on the S&P 500 right now, up a little more than 1/3 of 1%. The NASDAQ rising about the same. It's the small caps that are so interesting. The Russell 2000 up 1.5% as WIRP, the World Interest Rate Possibility Screen on the Bloomberg terminal, indicates we may now get 3 rate cuts this year from the Federal Reserve, and as a result, the small caps are rallying. Katie?
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Evercore ISI downgrading Yum Brands to inline and cutting its price target on the quick service franchise because of disappointment about Taco Bell trends. Next up, Morgan Stanley upgrading Sweet Green to equal weight. The firm sees the company's Infinite Kitchen as a positive catalyst. Now, the Infinite Kitchen is a system that robotically assembles salads. And finally, Piper Sandler downgrading Dollar Tree to neutral. The analyst says that the company is disadvantaged no matter who wins the White House. Trump's tariffs policies would probably cut profit margins. Meanwhile, Biden's proposal to expand overtime pay protections may hurt Dollar Tree's earnings. Shonali.
And coming up, Katie, Blue Owl is pushing deeper into the private credit market with the deal to buy credit manager Atalaya. Mark Lipschultz, Blue Owl Capital's co-CEO, joins us next for today's Wall Street Beat. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From the world of politics to the world of business, Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Capital, one of the fastest growing firms on Wall Street, pushing deeper now into the red-hot private credit market. The company announcing that it will acquire credit manager Atalaya in a deal valued at roughly $800 million. The deal is today's focus of today's Wall Street Beat. Joining us now with an exclusive interview is Mark Lipschultz, Blue Owl Capital co-CEO and co-founder. And it's interesting because this is your third acquisition in a matter of 3 months. So why now, and how much more firepower do you have to do more deals, frankly, after this?
Great to be here, and thank you, and particularly at this moment. The Atalaya investment is really a strategically critical one, alongside, as you note, a couple of other critical transactions we've completed, all of which together are about positioning Blue Owl to be the full service provider, full spectrum provider across the private credit marketplace. And that's really what Atalaya is, an extraordinary franchise, a couple decades old now, in this now very focused market of alternative credit or asset-backed credit.
How big is that asset-backed lending opportunity? Because everywhere we go across Wall Street, you see more and more private credit managers diving in.
It's a very big market, and there's a lot of similarities to what private credit, private corporate credit, looked like just about 10 years ago when we started Blue Owl, Owl Rock, and a chance to really take an asset class, and we see the opportunity going forward in alternative credit to be analogous to and possibly bigger than the opportunity in corporate credit. The marketplace for asset-backed credit is about $7 trillion. So just mathematically, it is bigger than the syndicated loan market, if we think about that as a proxy for the marketplace for direct lending. So I think it is both a bigger market, and we're also at a time where investors have a greater appreciation and understanding for the benefits of investing in private credit solutions, which people have learned, I think, very well through the success investors have had over the last 10 years on the corporate credit side.
Let's talk about the price tag. So you're paying $450 million up front. You're getting about $10 billion, a little bit more of that in AUM. How did you get comfortable with that 4 to 5% figure of AUM?
So for us, in acquiring a business like this, just like in everything we do in our business, it's a bottoms-up calculation. So, you know, at the end of the day, the measure you used, certainly ultimately a touch point, but for us, it's about the fundamentals, and we look at Atalaya. Again, you know, this is a company, they're on their 9th flagship fund in alternative credit. Maybe a hot topic on Wall Street today. It's been a 20-year topic for Ivan Zinn and his partners. So we look and we see an opportunity both on the basic organic growth of Atalaya, but also the combination. When you bring together the credit capabilities, including some asset-backed capabilities we have at Blue Owl, marry them with Atalaya, we see a tremendous amount of growth because we can deliver a product that will deliver great risk-adjusted returns for investors. So the fundamentals to us are appealing. I might harken back, and this is something Bloomberg covered and reported on at the time when we acquired Oak Street. Now the real estate business of Blue Owl, actually very similar in size, had about $10 billion in assets. Today that business is approaching $30 billion in assets. Run again, very similarly. Mark Czar, a spectacular entrepreneur. We've become the market leader in triple net lease. We've now added a real estate finance capability in Prima. When we now complete the picture by adding Atalaya, we have the full range of credit capabilities to meet the moment.
Let's talk about also how many employees you're adding. Roughly 115, I believe. That brings your headcount to almost 1,000. With all these acquisitions that you're doing, all this onboarding, I mean, how do you maintain a cohesive culture?
Such a spectacular question. Culture is monumentally important to us and monumentally important to the future of our business. We have these tenets that underpin everything we think about at the firm. And it's a firm for us. It's built around mutual respect. It's built around constructive dialogue, excellence, one team. These are themes we talk about a lot. Atalaya has that culture. Atalaya has a strong culture, a strong cohesive culture. The team's been together a long time, and they too are all about excellence. And they have skills on top of those cultural attributes that blend with us well. And we look at that actually first. We have to find a cultural blend before we can sort of get on to the business fit. But the cultural blend is there, and the business opportunity, their skills, they've got a data science team that really knows how to mine. It is a different adjacent business to corporate lending when you're dealing with the millions of data points available in consumer and commercial credit. So really going to be a powerful combination in our view.
Why are banks giving up so much business to alternative asset firms like yours? Why isn't Jamie Dimon saying, like, I'm taking this back?
So I wouldn't presume to speak for Jamie Dimon.
I don't mean specifically.
No, of course I understand. But I would say this: I think that much like corporate credit, it's not so much the banks, giving up as much as we're presenting a solution that's so fundamentally different for the user. So if we think about any of these types of financings, when we talk about the bank market, it's a very transactional market. It's about, look at its simplest form, a bank has one-day assets they're using for long-dated lending, right? Deposits can be called anytime. We saw that with Silicon Valley Bank. The heart of Blue Owl, the heart of private credit, is something as straightforward as this. Look, if you're going to make long-term commitments of capital, then you ought to have long-term commitments of capital to you to match them with. Duration matching is the secret to stability.
How much is the originator of these loans changing? Because you looked, for example, at Bank of America this morning, the average FICO score for a car loan is above 800. Most of America does not have a FICO score above 800. So when you're thinking about these asset-based loans and where they're even generated from, where are they coming from?
A really good question, because we are seeing, of course, with fintech broadly defined, but financial innovation, a lot of new channels where these products are being originated very successfully using technology to support that.
Of the world.
Absolutely. And in fact, Lending Club has been a partner as the bank market has retreated from providing a lot of this financing. Perfect study. Lending Club has been a partner to Atalaya. Atalaya has done $1 billion of financing for Lending Club. Lending Club originates consumer credit, but they're not a balance sheet business. So once again, you have the originators, or you have people who transact, and then you have to have the people who are really going to hold and manage that risk for the benefit of investors.
Mark, your stock has more than doubled since 2022. How important is your stock price to you?
Very. So we're very focused on driving our stock price.
Shonali mentions actually that you're worth now $10 billion more than Carlyle, which is a big market cap.
We have been very fortunate to be able to position our business in a place where both growth is substantial, private credit, this real estate arena that we're in is very high growth. So that's our highest growth business, is our real estate business. So we've been able to position in places, markets where there's a lot of growth, and then build a business model that's about durability and predictability. Our business, our revenues are almost all fee-based, and our capital is very heavily tipped toward permanent capital. Over 90% of our revenues come from permanent capital sources. So I think the stock reflects that we've got a different model. It's higher growth, it's more durable, it's more predictable. We intend to keep it that way. And frankly, businesses like Atalaya and this $7 trillion addressable market give us the tools to go beyond 2025, and a year we've talked a lot about with the marketplace, into the back half of post-2025, and really continue to grow and drive our business and our stock price.
Well, great having you on Open Interest. Thank you so much for joining us. Mark Lipschultz there of Blue Owl Capital. Coming up in the next hour, Joanne Feeney, Portfolio Manager at Advisors Capital Management, why she says earnings are more important than the macro now. This is Bloomberg.
the linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live from YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. We're going to check in on all things politics. Jody Schneider, political news director for Bloomberg TV and Radio. She's going to join us to give us the latest from the Republican National Convention. We do have a vice presidential candidate on Mr. Trump's ticket, so we'll talk about that. We're also going to check in with Ira Jersey. He's Bloomberg Intelligence senior U.S. interest rate strategy. We got some economic data today. The retail sales came in, I'd say, much higher than expected. What does that mean for the Federal Reserve going forward? And then we're going to talk commercial real estate. Douglas Durst, chairman of the Durst Organization, on the state of this commercial real estate business here today. So we got a lot coming up in this first hour of Bloomberg Intelligence program, and we're going to kick it all off with Mr. Charlie Pellet.
Thank you very much. Just turning negative. NASDAQ down 8 right now, 18,464. Little changed on the NASDAQ Composite Index, but dipping into the red 30 minutes into the trading session. We've got the S&P pushing higher. Could see the 38th record of the year at the close today. A gain right now on the S&P of 0.3%. The Dow now surging 464 points, up 1.1%. So the Dow, the S&P higher. NASDAQ 100 index both lower. And the Russell 2000 up another 2% today, building on yesterday's gains. And to put that in context, the S&P by comparison up by 0.3%. We're brought to you by Interactive Brokers. Discover the future of trading with their next generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. Stocks hitting records after solid retail sales suggests the economy's main driver still holding up as inflation recedes and the Federal Reserve nears a start to cut rates. Again, we have got stocks trading mixed. The 10-year right now, 4.20%. The 2-year, 4.46%. Spot gold up $22 the ounce, up 0.9%. And West Texas Intermediate crude right now down by 1.6%. As for the market backdrop, Chris Verone is head of technical and macro strategy at Strategas Securities.
I think this is a market that's pulling forward Trump win. The leadership profile looks remarkably similar to what we saw in the weeks following the 2016 print. So you have that as well. Then you have, I think, the macro, which I would describe as still certain sectors justifying the soft landing call.
Chris Verone of Strategas, interviewed this morning on Bloomberg Surveillance. You can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. After earnings this morning, Morgan Stanley up now by 0.8%. Rival Goldman Sachs, which reported yesterday, up 2.2%. Bank of America up by 4.3%. Schwab, though, tumbling by 6.5% after earnings. So again, recapping here, NASDAQ now negative by 0.2%. S&P holding on to a gain of 0.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. I'm Alex Deal alongside Paul Sweeney. Happy Tuesday. I'm wondering what we're learning right now from earnings and how much of the Trump trade is still in there. I go to United Health for a second. It's up 143 points on the Dow, for example, about 4% change to the upside. Mizuho saying it's actually maybe looking forward to a President Trump White House, and that maybe Medicare will get more members because the Affordable Care Act will get shaken up a little bit. So it's still, that's still coming in when it comes to earnings.
Lots of plays out there. We had the retail sales came out this morning much higher than expected. I think I just look at that core group, 0.9% positive versus a 0.2% estimate. We had some upper revisions to the past month. So it looks like the consumers, by and large, hanging in there pretty well.
Yeah, but they took a page out of my book. They're shopping on sales, baby.
Exactly.
Yeah, that's how I roll. All right, let's get more right now on this market with Norma Linda. She's joining us. I mentioned United Health. Let's go to that first. Walk me through some of the details.
Yeah, so we're watching United Health. It's up this morning in trading, up 4.8%. Now, that's the highest in 7 months. But as we're really parsing through the numbers and we're looking at things here, the main details that I'm watching are the profit. So it did beat on its profit expectations. But as you mentioned, when we're looking at those medical costs, that is still in focus. And one thing that I did want to point out is that when we're looking at a lot of its international businesses, when we're looking at the international presence that it's really been hoping to expand, it recently did sell a business in Brazil and intends to sell its remaining operations in South America, which truly does mark a retreat from the international expansion that began more than a decade ago and has been a significant focus for the company. But today, what's the most specific thing that everyone is really nailing in on is that profit beat, and we are seeing a pop on the stock this morning off of that.
Stock's up 4% today, but it's pretty much flat for the year. So not a lot going on there. So I guess a lot of uncertainty around some of those big health companies. It's almost a $500 billion market cap, $490 billion market.
Because they warned, like they're basically they're not going to get reimbursed as much as everyone was as they had previously been. So that ratio was going to be lower. They had definitely warned on that. Charles Schwab though down 6%. Wait, I thought we were all trading lots of stuff.
Yeah. So I thought, but apparently I stand corrected. So as we're looking at Charles Schwab here this morning, what is really in focus is that it reported fewer clients opened new brokerage accounts than analysts had initially expected. And of course, for a brokerage firm, you'd obviously want to get some activity when it comes to getting new people opening accounts here. So its new brokerage accounts in the previous quarter rose to 985,000, which is up from the 960,000 from the same period earlier, but it's definitely less than analysts were expecting, which was 1.04 million that the survey had said. And so this is actually bringing the stock down pretty substantially. It is falling as much as 8.4%. That is the worst day and the lowest level since March of last year, which we remember were really the depths of last year's regional banking crisis.
It seems like adding 980,000 accounts in a quarter, that seems like a lot.
I know.
I think it's a lot.
Holy cow.
You have to wonder too, like, are we running out of the pandemic saving thingamabob, the money we're making off of high rates? Like, is there a macro story here?
I don't definitely pulling on it, right?
And Match Group, what's going on there?
Yeah, so Match Group, to point that one out, that is actually really interesting because it's the owner of the dating app Tinder. Everyone's very familiar with.
No, not so much.
Okay. I'm familiar with.
Everyone of a certain age, and I don't know where the cutoff is. 30? Is he high?
What's your estimate?
I mean, he's asking me, but I'm okay. 35 max.
35 max. That's what our expectation for Tinder.
Well, just for the dating apps in general.
Okay, dating apps in general. We'll go with it.
No, I wouldn't say that. I know people who've like gotten divorced who go on dating apps.
Like Match.com.
Right.
Yeah, but like for Tinder
Christian
and
Tinder,
okay.
I would say 35 max.
Okay. We'll go with it. I believe you.
Okay, you go do that research.
I'll do it. So Match Group is actually the owner of Tinder, and we do know that Tinder has really been struggling, especially as we think about dating apps. Tinder specifically, its paying customer base has shrunk for 6 straight quarters. But what's really in focus here is Starboard. They're coming in as the 3rd activist investor this year to take a stake in Match Group.
Okay.
And so we are seeing a pop on the stock. We are seeing Match Group shares up as much as 8.4%. That is the highest intraday, or the best day since January, and the highest intraday level since April. And so we are seeing investors really coming behind the stock and pushing it higher, as they do have expectations that bringing in this 3rd activist could propel the stock forward.
All right, thanks so much, Nora. Really appreciate it. She's going to do some work on us to sign the max age
I'll
for
let you know.
Tinder, and we'll get back to you on that. All right, let's go to Jody Schneider now, political news director for Bloomberg Television and Radio. She's standing by in Milwaukee. Jody, the event obviously last night was former President Trump walking in with a bandage on his ear and then declaring that VP pick of J.D. Vance, the senator from Ohio. Walk me through what you learned last night.
Well, yesterday we did have that the announcement of J.D. Vance as the pick was done in the afternoon, and then he showed up at the venue here at the convention hall earlier in the evening, and then last night we did see former President Trump, the almost nominee. He will. Well, he's been now designated as the nominee. He just has to give a speech on Thursday night. But he and J.D. Vance were shown together. Neither of them spoke. Their speeches will be Wednesday and Thursday night. But it is clearly a passing of the torch to a new generation, making sure that this is the whole philosophy of MAGA and former President Trump's philosophy has been given now to a new generation, because the vice presidential pick, J.D. Vance, espouses those same principles.
Well, he didn't always espouse those same principles, did he? Give us a little sense of kind of how J.D. Vance has evolved over the last several years as a politician.
Yeah, that's right. He's had some well-noted differences with former President Trump. He once called him noxious. He's somebody who was first of all, he had a business career before he was a politician. He was a venture capitalist. He wrote a best-selling book, Hillbilly Elegy, which is said to be some of the principles in there about how he grew up poor in Ohio and kind of overcame that. It's been said to be a populist book trying to reach out to more working class voters. He evolved from that and then became a United States Senator from Ohio. In recent years, he has honed very closely to the principles that Donald Trump talks about, and he is said to have been a favorite that Donald Trump's sons, Eric and Donald Trump Jr., pushed for him because they saw him as he would continue the MAGA brand, Donald Trump's brand, into the future. He's 39 years old, not even 40 years old, a whole different generation than Donald Trump.
It was interesting, Jody, because part of the rhetoric yesterday after the potential assassination was that President Trump was speaking about unity, which is something he doesn't do very often. J.D. Vance, however, went to the far right and was saying, look, blaming President Biden for the attack on President Trump. Very, very divisive. And so some people were talking about the fact that would President Trump pick a united vice president? He didn't. Did he do that because he also will stay divisive, or does it give now President Trump the ability to be more of a unifier of the Republican Party while J.D. Vance holds the core?
Yeah, that's a good question. And I think there is some of that. Donald Trump now can sort of say, okay, we don't want, he can come out, especially since he was the target of an assassination attempt, he can come out and say there's no place for political violence. And J.D. Vance can kind of, be the tougher one on that, right? He can be the one that says the things that Donald Trump, the top of the ticket, doesn't want to say. But clearly there had been some talk of perhaps, Donald Trump was going to pick somebody who could reach out more, say, to women voters, to racial minorities, for instance, trying to get some of these swing state voters. But this is very much a doubling down on the brand, doubling down on the core of their constituency, the white male working class voters.
All right, Jody, thank you so much for joining us. Jody Schneider, she's a political news director for Bloomberg Television and News, joining us remotely from Milwaukee, Wisconsin, the site of the Republican National Convention. We had some economic data this morning. Retail sales came in much stronger than expected, showing that the consumer is doing more than kind of hanging in there. So that begs the question, how is the Federal Reserve going to view the consumer, the labor market, and the U.S. economy here? Ira Jersey joins us, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Ira, I'm looking at the 2-year Treasury. It's kind of flat today. It's a 4.65, or I'm sorry, 4.65 on the 2-year. How do you think the Fed kind of is taking in some of this economic data we've seen over the last several days?
Yeah, so the data's been mixed, I think you have to call it. When you look at the data from last week, it was a little bit weaker than expected, and in some cases, and today's retail sales numbers, like you mentioned, were pretty decent. You look at the control group, which is the input into GDP, and that was up 0.9% on month on month. So that's a reasonably solid number. Now it won't stay that way, right? It'll be pretty volatile as people spend money and stop spending money after school year starts. But I think that it's still an open question as to whether or not the Fed starts to cut in September. I'm personally not worried about September or November. I'm looking more at what is the market and where is the market likely to price for the Fed to ultimately cut to. Right now, that's around 3.5%. So I think that data like this, if it keeps on coming in, I don't see much of a change in that. And in order for the market to price for deeper cuts, you need to see an even more pronounced slowdown in the economy than we've had so far.
The steepener's been the widowmaker all year. It got a reprieve in the last few days. We're not getting that again today. What does the steepener wind up playing out?
Yeah, so, well, the steepener probably will play out. We've been harping on the idea that the steepener is going to keep on coming and going until the Fed actually starts to cut interest rates. And once the Fed does start to cut interest rates, that's when you'll see the steepening trade, pick up a little bit. There is a risk here, and we just had our global fixed income strategist call internally within BI. And someone pointed out a good question. You might have a situation where if the Fed's cutting interest rates, the short end rates, so 2-year yields, for example, might go down significantly further. But at the same time, if Donald Trump is elected president and he has some protectionist policies that increase inflation, there is the possibility that longer-term interest rates, he suggested that maybe longer-term interest rates could go up. I actually just think that they don't go down as much or as quickly as we think. And there is that risk where you can have 10-year Treasury yields kind of hang out where they are. Most of the move is going to come from the front end. It's really going to come from policy expectations and where the Fed's terminal rate is, and that's where the curve moves are going to come from. And that's the same thing today. Yeah, you see a little rally in the long end, but it's really the fact that the short end is going up or even staying flat that is causing these shifts in the curve right now.
Ira, when the Fed begins to cut rates, let's just say September, then what? How frequent did they cut after that? How much did they cut? How should we think about that?
Yeah, so, the market is not necessarily pricing sequential interest rate cuts. They have, the market's pricing for some chance of pauses in there. I don't think that the Fed's going to pause, which is another reason why I still think that while September is not impossible, that November is a more likely starting point for the Fed. Because once they start to cut, I think that they're going to want to cut sequentially 5 or 6 meetings in a row at 25 basis points. And unless the economy is really collapsing, they want to go in a regular and predictable fashion. Once they've cut, say, 125 to 150 basis points, then maybe they pause for a couple of meetings just to say, okay, look, we've just cut interest rates 150 basis points. We think we've eased monetary policy. Let's see what happens now. And then they can go again. But, cutting every other meeting, I mean, I think that's never actually happened before, so I doubt that it's going to happen again. It'd be kind of weird. I know the ECB just did it, but I don't think that the Fed's going to operate that way.
Yeah, I was going to say, and the ECB will probably do just that on Thursday by by not cutting rates. Hey, Ira, we super appreciate you. Thank you so much, Ira Jersey, a Bloomberg Intelligence Chief U.S. Interest Rate Strategist. I wonder, that point was so interesting that the 2-rate falls quite a bit because the Fed cuts, but the 10-year rate goes up quite a bit because President Trump gets in the White House. What does that do to the economy?
Exactly.
Lower short term, but it goes fast. Like, is it the speed or just the absolute level of the 10-year?
Yeah, exactly. I'm looking at the 10-year Treasury right now. It's up about 630 seconds, pushing the yield down just slightly, a couple of basis points, 4.20% on your 10-year.
You know who might have a feeling on all this and what it means for business? A real estate investor. So coming up, we're going to talk to Douglas Dirts. He's chairman of the Dirts Organization on the state of commercial real estate. Kind of get into what rates wind up meaning for the commercial real estate sector and how quickly it can move through the market. We'll have that coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long here at Bloomberg. A decidedly mixed market right now. We've got NASDAQ lower by 38 points, down by about 0.2%. But the Dow keeps on going. Another record up 523 points right now, up 1.3%. 40,732 on the Dow Jones Industrial Average. S&P by comparison up now by about 0.2%. The Russell 2000 also rallying today, with the Russell 2000 up now by about 1.9%. We've got the 10-year yielding 4.20%, the 2-year 4.46%. Spot gold up 0.9%, 24.45 the ounce, while West Texas Intermediate crude is down 1.6%, 80.57 for a barrel of WTI. Tesla shares today. Right now, we have got Tesla trading a little changed. It is looking to hire nearly 800 employees 3 months after CEO Elon Musk hastily ordered the largest round of layoffs in the company's history. Tesla actually down 1.7% right now. According to a Bloomberg analysis, those roles have steadily popped up on Tesla's careers page in recent weeks, with positions spanning AI specialists to more run-of-the-mill service jobs. Again, Tesla right now, Tesla falling by 1.7%. So again, recapping here, we got the Dow ripping higher, up 535 points, a gain of 1.3%. S&P up by about 0.2%. The Russell 2000 cannot be ignored today, again up by 1.8%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are live from the Interactive Broker Studio right here in Midtown Manhattan. It's like 100 degrees out today.
Oh boy.
Yeah, are you psyched that you're back in the office?
Subway platform is going to be something I'm looking forward to today.
Oh, yeah, ditto. And this is when you want to be working from home, right? You get the breeze, Jersey Shore. He's broadcasting from the beach. There it is.
That's my jam. But that's not the case. We are here in the city, and I want to talk commercial real estate because this is just a critical issue for the economy, for banks, and obviously for the folks involved in the real estate business. And there's no better person to talk to for commercial real estate than Douglas Durst. He's the chairman of Durst Organization, joining us live here in our Bloomberg Interactive Broker Studio. We appreciate that. Douglas, thank you so much for joining us here. The party line out there is commercial, particularly office real estate in urban areas. It's bad, and it's going to get worse, and maybe we don't know how bad it is. Is that the case, or are there different layers under that?
It's certainly the case that you don't know how bad it is because it's not bad.
Okay.
In our portfolio, we are almost 95% leased across the portfolio, except for a building that we started construction pre-pandemic, had to stop, and at 825 3rd Avenue, we're now about 40% leased in a year. Our other buildings are mostly fully occupied. At 2019, pre-pandemic, we had 3 large office buildings vacated because